Okay, good morning, everybody, and welcome to this session for 50 hours training for the registered valuer examination. So I'm Tarun Mahajan. I'm a chartered accountant and I'm based at Indore, Madhya Pradesh. And one of the major part of this portion I will be taking. So I hope all of you are all also on the WhatsApp group. So yesterday I have shared notes for today's session. I just request all of you to keep it ready. So once I would like to familiarize with all of you. So good morning, Anjuji. Hi. Good morning, Shailen sir. Good morning, Sanjeev Sharma sir. Good morning, Jatin sir.
Very good morning, sir.
Good morning, Sanjay sir.
Good morning.
Good morning, Amardeep sir. Amardeep sir. I can't see you, sir. Amardeep sir.
Good morning, sir. Good morning.
Good morning. Good morning, Atulji.
Good morning.
Good morning, Shubham sir. And good morning, Vishwanath ji. Praveen sir and Rajesh sir.
Good morning, sir.
Good morning. Good morning.
So if it is convenient, then you can turn on your cameras so that most of the time, actually, I'll be looking at my own screen. But meanwhile, I keep on looking at all the videos also so that I feel connected. Because otherwise, I am sitting in a closed, soundproof studio kind of room. And I can see nothing around me. I feel like I'm talking to my laptop. And sometimes feel weird about it also. So if I keep on seeing your videos, it will give me some energy. Right, sir. So here we go. Our whole syllabus will be like this. This is the examination pattern, sir. And it is like this. It's 2 hours examination. And it's 100% multiple choice examination, computer-based examination. You'll have to book a slot at one of the NISM centers and then go and appear in the examination. A computer will be in front of you, a monitor, a screen will be in front of you, and you will be allotted 2 hours of time. So 80 multiple choice questions of 1 mark each will be there, sir. Then 3 case studies will be there. Case study means, they will, in 1 mark MCQ, they write maximum 2, 3, 4 lines in the form of the question. But in a case study, they will write 4, 5 paragraphs. A whole A4 size page of material will be there. And below that material, there will be 4 multiple choice questions of 2 marks each. So 1 case study is worth 8 marks. Then there are 2 more case studies, and each case study will have 3 multiple choice questions. And again, each MCQ will be worth 2 marks each. So 8 plus 6 plus 6. 3 case studies, 8 plus 6 plus 6. Total 20 marks of case studies will be there. And 80 marks of single mark questions will be there. So this is how this 100 marks of paper will be, can be classified. 25% negative marking is there. So if 1 mark MCQ, if you attempt it right, you get +1. If you attempt it wrong, you get -0.25. If you leave it unattempted, that is 0. In case study, MCQs are worth 2 marks, and therefore negative marking will also be -0.5 if it goes wrong. If you leave it unattempted, then fine, there is no problem. Now, one more thing, when you attempt any examination, when you you can simply answer the question or you can skip it and go to the next. That is your choice. But even after answering the question, in examination center, in their software, they give you one more facility, mark for review. So suppose one MCQ is there and I say choice C is the correct choice, I mark it. But at the same time, I click a button which says mark it for review, you know. And one of the candidates reported to me, even I'm not 100% sure, but he said he attempted 67 questions and around 15 question he attempted, but at the same time he marked it for review. But at the time of submission of his test, he forgot to remove this mark for review. So when result appeared, it said you attempted 67 questions, while he attempted 10, 15 more questions, but marked it as mark for review. So just be careful whenever you appear for examination. Yesterday only I came to know about it. Hence I'm telling you at the beginning of the session itself. Either you don't mark it for review, or if you mark it for review before you submit your answer sheet, make it sure that you remove that mark for review thing. As far as, sir, one more thing I would like to tell you. So let's not take it as a classroom. Let's not convert it into a monologue where I keep on speaking and you keep on listening, sir. Let's not do that. A conversation will be highly appreciated. So any point of time, if you have a doubt, you can unmute yourself and you can speak out your doubt. Or sometimes if you feel like that you're not comfortable speaking it out, then simply you can type it in your chat box also. Or if you feel like that if you speak out, the flow of delivery will be interrupted, if you feel like that, I don't have any trouble. Then also you can put it chat box. So just feel free, or in fact, if you want to supplement something, I'm not here just to deliver and give you my part of knowledge, but I'm here also to take knowledge from you also, sir. Because everybody is expert in his own area of practice. And you can be expert of usually one thing only. So whenever you feel like supplementing what I'm saying, just feel free. I will also be enlightened. I will also learn something from you. And that will be really very kind of you if you can give your learning to all the participants, including me. Right, sir. So this is the examination pattern. And my focus in today's session and tomorrow's session will be two things. Number one, how to make valuation of equity. And number two, case studies. So my experience says that if you have cleared your professional examination, CACS, CMA, I think majority of chartered accountants are here. Just for the sake of introduction, sir, can you type just two things in the chat box? Your years of experience after the professional qualification and your professional qualification. Just two things. Number of years of experience and your qualification.
Can you repeat that, please?
Yeah, just type in the chat box two things, that how many years it has been you qualified your professional exam like CACS, CMA, and your qualification. Okay. So Amardeep sir is a chartered accountant with 15 years of experience. Atul sir is 18 plus years of experience. Vishwanath sir is 25 years of experience in practice. Wow, great sir. Pawan Garg sir in practice since 2004, 17 years. Wow. Oh, Shubhamji, wow. Shubhamji appears to be the youngest participant over here. Sir, it is 4 years of, okay, practice in CA. Okay, great. All right. And Shailen sir, company secretary based from Delhi, qualified in year 2000. 13. Okay, fantastic, sir. And I was listening to Vijay sir also. And Shalin sir, your mustache is really attractive. At one point of time, I was also having, beard and mustache. So I actually love it. CS with total, 20 years of experience in employment. Sanjay sir. Wow, sir. Great, sir. And Rajesh Gupta sir with 21 plus years of experience. Fantastic, sir. Anju ma'am, you have not posted. And Praveen sir also probably not posted. Okay, you qualified 2007. So like, okay, 13, 14 years of experience. Wow, great. Fantastic, sir. Fantastic. So most of the senior members are over here. Now, when you are in practice, sir, it's a plus point. Your seniority is a plus point. But in examination, to some extent, it becomes a minus point, sir. Because you know what happens, those who qualified in last 5 years, they still have in their memory what they studied in strategic financial management or financial management subject. But after 15 years, you leave CA final or CS. In CS final also, CS professional also, financial management subject was there. Was it there, Sanjay sir, in final at your time?
Yeah, it was there. Like it was same as what it was there in the CA curriculum.
Right, exactly,
Yeah, yeah.
exactly. So, if 15, 10 years plus when it happens, so what happens that it is washed out until and unless you are in practice of finance. So what I will do here is, my strategy here is, sir, there are two things. Number one is to focus on examination. Number two is to discuss the real life issues also. So my primary area will be to focus on examination, sir. Reason behind it is passing the examination and practicing the valuation are two different games, sir. In passing the examination, more of academic knowledge is required. And in doing practice, more of your experience is actually counted. So, and within the limited time period of 50 hours, and that too with so many subjects, income tax and SEBI and everything, Transfer of Properties Act and finance and equity and intangible asset, and so many things are there that within the limited time of 50 hours, we cannot explore the real life. So my primary focus will be on examination, how to crack it. And at the same time, I'll encourage that if there are any practical questions in your mind, just feel free to ask it. I'll also love to discuss that. I'll try to balance, but still more focus will be on examination. This is one thing, sir. Second is, I would kind of, I hope everybody is accessing this session through laptop. Is there anybody who is accessing through mobile phone? I think nobody. Okay. So on your laptop, you'll have to do one thing, sir. You'll have to open one. Okay, Atul sir is probably raised hand. Are you watching it through mobile phone, sir? Then I'll request.
Yeah.
Okay, then I'll request, sir, that you need to have laptop also in front of you, because we are not going to have a seminar kind of thing. We are going to have a workshop kind of thing. So next
Atul sir, I am unable to hear you.
Hello. Yeah, probably there was some disturbance in the connection. I got disconnected. Okay, sir. So here I go. So I was telling you, you can open one Excel sheet and you can keep switching between Excel and Zoom by pressing Alt and Tab key together. All right, sir. So with this, here we go. So this is some, past historical result. This is not really important for us as of now. So, sir, all of you are going to become registered valuer, and your primary task will be to make a valuation. Now, the thing is, what is value? And the answer is here. Value is sum of future benefits. So you want to calculate value of anything? Then first of all, you estimate life of that item for which you want to calculate value. Once you calculate life, thereafter you estimate all future benefits and then make a sum total of all future benefits. That is the current fair value of that particular item. So suppose I want to make valuation of a debenture. When I say benefit, then benefit must be measurable in the terms of cash flows, sir. When I say benefit, when I say benefit, it means cash flows. So what benefits do I have being a debenture holder? Future benefits. You can type your answer or you can speak out as you wish. But if you speak out, make sure that once you are done, again mute yourself. Otherwise the voice will echo. So being a debenture holder, what are my future benefits?
Interest income.
Right. So we have two answers, one in chat, one by voice. I just request everybody to participate.
And the principal that I'll receive at the end of the period.
Perfect. Perfect. These are the two cash flows. What is the opinion of other people, sir, ma'am? A simple question. Probably you're not answering because it is simple. We'll move towards difficult questions also, sir. We'll take baby steps, but believe me, we'll touch the height also. Okay, yes. So in future, I'll be receiving interest and the redemption price also. Okay, being equity shareholder in the company, what are my future benefits?
Dividends.
Right, Amardeep, sir.
Dividend, bonus shares, right issue shares, and if
Ownership.
there is any merger and acquisitions going on, then the ownership rights along with that trust, benefits of it.
Right, right. Exactly. But if I focus only on cash flows, then there are only two cash flows in case of equity shares. One is dividend, another one is sale proceed. Whenever I decide to sell it, and suppose if I decide to hold it till perpetuity, then there is only one cash flow in case of equity shares, cash flow. Yes, benefits are many, dividend right, bonus, split, consolidation, merger. There may be various kinds of benefit. But when I talk about cash flows, there is only one single cash flow till infinite years, and that is dividend. Perfect, sir. Perfect. And if somebody speaks out, then it doesn't mean that rest of the people need not to answer it. I expect everybody to answer it either by voice or by chat. All right, sir. Suppose I'm trying to make valuation of a building. What are my future cash flows, sir?
Rentals.
Rent, sale proceeds.
Right. Rental income will be there.
Rental.
Right, Atul sir. Rental income will be there. So, and if I decide to sell it someday, then the sale proceed will also be there. If I don't decide to sell it, then for a long period of time, I'll be receiving the rent income. Then similarly, so whatever kind of thing, anything and everything in this world, if you're trying to make valuation, you need to make it sure that there is one simple thing, that estimate the life of the item, then estimate all future cash flows, make a sum total of those cash flows, and that will kind of give you the current fair value. Say you want to make valuation of a cow. So by owning a cow, your future benefit is it will be giving milk, or maybe it will give you a calf. So by selling the milk or by raising the calf, you will be getting cash flows. Whatever future cash flows you get, you need to make total of all those cash flows, and that is how you calculate the value. Anything, any item, any person is valuable if it can generate cash flows in future.
So Tarunji, we can say this in that way that one kind of income is a operational income, and the second one is a like a terminal, or we can say
Terminal.
capital income. So two
Capital.
incomes we have to be club always keep in mind, right?
Perfect, sir. That's perfect. So Vodafone Idea is not having, much value. Bharti Airtel is not having much value because people are seeing that slowly and gradually they are kind of sinking. But Reliance Jio and Reliance Industries Limited are valuable because people are seeing that it has future profit generating capability. So if you can generate profit for somebody, you can make a favor to somebody, then you are valuable. If you cannot give any future benefits, then even after your golden past, you are not valuable today. Now, but one more thing, I'm asking you one simple question. Oh yes, I forgot one thing when I was talking about cow, the cow dung also. It is also one of the most valuable thing. You can make, what do you call it? Kande, and that's a fuel. Right, sir. So I'm giving you some one simple question, and you need to type your answer as fast as you can. Let's see the top 5 answer. You need to make sum total of 3 numbers. 1,000 rupees, 1,000 kilometers, 1,000 liters. Make a total and type your answer as fast as you can. 1,000 rupees, 1,000 liter, 1,000 kilometer. What is the sum total, sir? Okay, Shubhamji is saying not possible. Amardeep Singh sir is also saying not possible.
Not possible, sir.
Okay, Sanjeev sir is also saying the same. Come on, everybody, just even if your answer is repetitive, already somebody has answered, but you still have to answer it, sir. Yes. Yes, no answer. That's also an answer that there is no answer. Exactly. Why can't we make a sum total? Because the unit of measurement is not same. Because the unit of measurement is actually different. Okay, let me ask you a different question. Now make a sum total of 5,000 rupees, which is receivable at the end of first year, 5,000 rupees, which is receivable at the end of second year, and 5,000 rupees, which is receivable at the end of third year. First year, second year, third year, 5,000 rupees, 5,000 rupees, 5,000 rupees. Make a sum total, sir. Post your answer as fast as possible. Yes, sir. Exactly. So Shubhamji, you are going to be one of the fastest answer maker in the whole session. I guess because you are the youngest one, you cleared in last 4 years only. And that's why this SFM must be in your mind.
Thank you, sir. Thank you.
In fact, Initial 1 or 2 hours you will find to be elementary because we are going step by step, considering all people in mind. Right, sir? We cannot again make a sum total, and the reason behind it is very simple. Again, the unit of measurement is not same. This is 5,000 rupees of first year. Rupees is not the unit of measurement. Rupees of first year is the unit of measurement. Then 5,000 rupees of second year, 5,000 rupees of third year. Unit of measurement is different. Therefore, you cannot make a sum total. To make a sum total, either you need to bring down all the cash flows at 0 year level, then the unit of measurement will be same, or you need to bring them up to the third year level, then again the unit of measurement will be same. So either you will have to calculate future value of all cash flows so that all are at same platform, then only you will be able to add it, or calculate present value. But we don't calculate future value because we don't make valuation. What will be value in 2030? No, I need valuation today. Therefore, I'll have to calculate present value of all future cash flows. So in CA Foundation, there is one concept which is named as time value of money. And here the formula is like this. Future value of money is equal to present value of money multiplied by 1 plus rate of interest raised to the power n. In short form, I can say FV is equal to PV. FV is equal to PV into 1 plus R to the power n. FV is future value, PV is present value. R is the desired rate of return of investors. R is desired rate of return of investors. N is number of years. Now this is, the formula for compound interest. If somebody tell me that how do I calculate future value using simple interest, in that case, the formula will look like this. The formula is future value is equal to present value multiplied by 1 plus Rn. So in simple interest, interest is always calculated on principal amount. In compound interest, you calculate interest on principal as well as interest on interest. We will hardly consider, simple interest. We will most of the time, or I can say almost all time, we will actually consider compound interest only. So let's reject this formula of simple interest. Now this is for future value. How do I calculate present value? If I, shuffle this formula, then this will become PV formula. So PV will be equal to FV divided by 1 plus R raised to the power n, because FV is equal to PV into 1 plus R raised to the power n, and therefore PV is equal to FV upon 1 plus rate to the power n. Let's do one question to understand this concept properly. Suppose a bond. Why should I call it a bond? I will better call it an investment or an asset. This asset may be a bond, it may be equity share, it may be a property, it may be real, livestock or anything in this world. An asset is expected to give rupees 5,000, 6,000, 7,000 and 8,000 from year 1 to year 4 respectively. Calculate sum of present value of all these cash flows at the rate of 10% per annum. Calculate sum of present value of all these cash flows at the rate of 10% per annum and also interpret the result. Now, these cash flows at various point of time, think of them as time step. Step 1, step 2, step 3, step 4. First step 5,000, second step 6,000, third step 7,000, fourth step 8,000. Then the next thing I do is I calculate present value. So 5,000 rupees will have a present value of 4545. And similarly 4959, 5259, 5464. Once I calculate present value, so first year is brought down to 0 year, second year is brought down to 0 year, third year is brought down to 0 year, fourth year is brought down to 0 year. Once all the cash flows are at 0 year, they are at same platform. Their unit of measurement becomes same. And then I can make a sum total of all these cash flows to arrive at current fair value of this asset of this bond, 20,227. Present value will depend on discounting factor. Yes, exactly. Amardeep sir, exactly. And discounting factor depends on the discounting rate. So now one terminology, this desired rate of return, this R, this R or desired rate of return is also named as discounting rate. You know why? R is in denominator. So when you divide by 1 plus R to the power n, the cash flow actually reduces. Look here. This 5,000 becomes 4,500. 6,000 becomes 4,900. So cash flow reduces or cash flow is discounted. That's why the desired rate of return is better named as discounting rate. Let's do this question in MS Excel. So I'm sharing one MS Excel file. You also open one of the files at your laptop, sir. You can also do one thing that you can resize the Excel window like this. And then you will see Excel sheet in half of your laptop window and Zoom session in remaining half. So just take 1 or 2 minutes time and arrange it accordingly on your laptop screen, sir. Resize both windows, Zoom window as well as Excel window. So half of screen you can keep Excel window, other half of screen you can have Zoom window. All right. I hope you have done that. So now we are going to solve question number 1. There are 3 ways to solve this question. I'll go one by one. So make a table like this. Here 1, 2, 3, 4. And the right amount, which is 5, 6, 7, 8,000. And then we will calculate present value. Present value factor we will calculate at the rate of 10%. When I say present value factor, what do I mean? Look, I can rewrite this formula in this manner also. Look, rather than writing FV upon 1 plus R raised to the power n, I can write future value multiplied by 1 upon 1 plus R raised to the power n. 1 upon 1 plus R raised to the power n. After some time, you might be thinking that I have started discussing formulas. And at some point of time, there will be too many formulas. And then you will have a feeling that if all these formulas are written at one place and given to us, we will become more comfortable. So I have done that, sir. And yesterday, the PDF file I shared with you, last 2 pages of that PDF file contains all formulas which I'll be using during the session. So don't worry, all the formulas will remain safe with you. So, I can write this formula like this also, FV into 1 upon 1 plus R raised to the power n. This 1 upon 1 plus R raised to the power n is actually named as present value factor. And when you multiply it by future value, you get present value. So I can say present value factor or discounting factor is simply present value of rupee 1. Now I get back to this sheet, sir. I hope everybody has created this sheet with 2 columns. Make it sure that your row number and column number remains same as I am doing. Like I have written year in cell A2. So if you also write year in cell A2, then later it will be easy for you to reconcile. Okay, so now let's go ahead. Just give me a moment. I will, sorry. So what do I here? I'll do 1 divided by, okay, let me tell you one thing. Excel works on BODMAS. So if you tell Excel that 2 plus 2 plus 3 multiplied by 5, you want to do 2 plus 3, that is 5, then 5 multiplied by 5, that is 25. No, Excel will first multiply and then make addition. So the answer will not be 30 here, the answer will be 17. Look here, Excel works on BODMAS. And what does that mean? BO stands for bracket open, D for division, M for multiplication, A for addition, S for subtraction. So just keep in mind while you are creating any Excel formula, 1 divided by, now I need to put it in bracket, because if I write 1 plus 0.10, then Excel will first divide and then add. I don't want that. I wish that 1.10, that is 1 plus 0.10. Or I can write 1 plus 10% also. It is same thing. 1 divided by 1 plus R raised to the power n. To raise the power, this cap sign should be there. Shift 6 on your keyboard. If you type shift 6, you'll get this cap sign. This is for power. And for power, I'll give cell reference A3. So this is 1 divided by 1 plus rate raised to the power n. There may be one question. Can we use MS Excel in examination also? Yes, definitely you can use MS Excel in examination. They do allow it. You can open Excel and you can keep on switching between examination window and Excel window. And that's why we are studying this. Now we need not to write this formula 4 times again. I will simply copy it, Control C, and then Control V. But there are various other ways of copying it down. One of the ways is you select this and then press Control D. Select this including 0.9090 and then press Control D to copy down. Control D means copy down. Yes, sir. That can also be done. Various ways. There are various ways. Now, one more way of doing this is you can drag it down. When I say drag it down, it means like this. Look here. When I select any cell, so one square, can you see one green square at the bottom right corner of the cell? This is called the drag handle. So as soon as I put my cursor at this bottom right corner, that is drag handle, white cursor will turn into a black cursor. See, this white cursor turns into white plus sign, turns into the black plus sign. And then with the left mouse button, I can drag and drop it. This is one of the ways of copying it down. There is one more way of copying it down. Just put the cursor at the drag handle and double click it. So you need not to operate the mouse also to drag it down. In case you need to drag down, say, for 100, 200 years, then rather than dragging down, double clicking is even better choice. You can double click here and you'll get the same thing. All right, sir. Okay. Now, the next thing I'm going to do is to calculate present value. How do I calculate present value? I take this amount and multiply it by present value factor. For your convenience, I will copy this formula also in adjacent cell. Simply, I multiplied these two items and again I put the cursor here and double click it. So I get present value for each single year. Here, if you want to do formatting, you can do Control-1. If you do Control-1, then formatting window will actually open. In formatting window, you can say, this is not a general format, this is a number format. And in number format, I need it up to 0 decimal places with 1,000 separator. Okay. Whatever, the way you format it, you can format it. So now it will look like comparatively clean and easy to understand. 4,500, 4,900, 5,200, 5,400. Then to make a sum total, you can press Alt equal to. Either you can type the formula equal to sum, bracket open, select range, close bracket, press enter, or you can do Alt equal to. That will automatically make a sum total of all the adjacent cells above, all the connected cells above. So Alt equal to is to make sum total. So finally, we got the answer. And the answer is, okay, allow me to copy this thing also. Now this was for this cell and the formula under this cell was like this. Control C and all right, sir. Any doubt in this to anybody? Okay. So if you have done this, let's learn second method. The second way of doing this is using PV function, which is inbuilt in MS Excel. So there are some functions which are inbuilt in Excel and you need not to type a formula like this. So PV stands for present value. FV stands for future value. All these nomenclatures are already there in the PDF file I have shared with you, sir. If you do have a printer available with you, then it's preferable that you take a printout of that PDF file. That will be really handy. NPER stands for number of periods, and then rate is discounting rate, or you can say desired rate of return of investors. You need not to note this down, sir. PV, FV, and PER rate. It is already written in your PDF file. You just focus and try to memorize it now. And you know, it's easy. PV, present value. FV, future value. NPER, number of periods. Rate is actually rate. And PMT stands for payment. It is amount of one installment. In case of an annuity, the question is, what is annuity exactly? So I'll give you example for annuity. Suppose somebody wants to give me 1,000 rupees at the end of each of the next 5 years. Somebody wants to give me 1,000 rupees at the end of each of the next 5 years. So this is a series of amounts where all amounts are equal and all time gaps are also equal. All amounts are equal and all time gaps are also equal. This is called annuity. An amount of one installment in this annuity is denominated by PMT in Excel. So PMT here is 1,000 rupees. So now we will be using this present value function to make valuation of this debenture. So I'm just doing this thing that I'm copying year and amount to A18 position. You also copy it down, sir, to A18 position. And then I will directly calculate present value with PV function. Atul sir, have you got the laptop?
No, as of no.
No. Okay. So try to arrange one.
Yeah, I'll do that.
Okay. Thank you, sir. Praveen sir, are you with us?
Yes, sir.
Okay. Are you doing, sir?
Yes.
Okay. Thank you, sir. So now I'll be using PV function. Just give me one moment and it's like, oh, I'm sorry. I shared a wrong screen. Okay. So just for your convenience, I'll zoom in. Now look here, I'll do equal to. All the functions in Excel start with equal to P. As soon as I type P, look here, a list of all functions which start with P in Excel are here. But I want PV, present value, and then bracket open. Now the beautiful thing is that you need not to memorize Excel functions. Like here, it is itself offering you the help that first you need to input rate, then put a comma. Then you input NPER and put a comma. Then you input PMT and a comma, then FV and a comma, then type, then bracket close, then press enter. Right, sir? So here I'm doing, first of all, I'll input rate, which is 10%. Be careful either to type 10% or to type 0.10. If you simply type 10, Excel will consider it to be 1000%. So better to type 10%. Now look here, the rate is written in bold letters. This help just below the cell is named as tooltip. Excel is offering you tooltip, so you need not to memorize the whole function. First, you need to input rate because the rate is written in bold letters. Now, as soon as I put a comma, instead of rate, now NPER is in bold letters. Okay, it means the next thing you need to input is number of period. So I click here, A19, first year. Then look, NPER is in bold letter. Then as soon as I put a comma, PMT is in bold. But I don't want to input any PMT because this is not a case of annuity. 5,000, 6,000, 7,000, 8,000 amount is changing. Annuity, when the amounts are equal, time gaps are equal, then only the PMT is amount of one installment. So I would like to skip PMT. Therefore, I'll press comma again. Look here, PMT is in bold letter, one more comma, and now FV is highlighted. So at place of future value, I click this because 5,000 is receivable in future at the end of first year. I click this. Then the next thing which can be put here is type. But you know, type is related to PMT. Now we have skipped PMT. Therefore, we will skip type also. So FV is B19. I press enter. And I get minus 4545 rupees. Look here, I'll just copy the formula in E column. Now you might be thinking, why this rupee symbol is there? Some of you might be getting a dollar sign. Some of you might be getting a pound sign.
Yes, yes,
Right, sir?
yes.
Oh, that depends on the Windows regional setting. If you go to control panel and change it to India and rupees, then it will start showing rupees. But you can do one more thing. You can do control and one. So that will open your format window. And here you can see, I'll zoom it for your convenience. Currently it is showing currency format, and that's why this rupee symbol is there. So instead of currency, you know, here also I'll get various choices of currency. Rupee, Armenian sign, Azerbaijan currency sign, and various Bitcoin, Kazakh, everything. That's fine. But rather than having the currency, I'll choose the number format. And in the number format, I can say I just need it up to 0 decimal points. And then I press OK. So this rupee sign problem will be gone. Now the second thing you must be thinking is why the minus sign is there. You know, Excel thinks it like this. If you want to receive 5,000 rupees, receive 5,000 rupees at the end of first year, then as of now, at 0 year, you will have to pay 4,500 rupees. If you pay 4,500 rupees now, outflow, then only you will receive 5,000 rupees at the end of first year. Excel think it like this. If you don't like the minus sign, you know, minus sign is not a problem. We can simply ignore it in our brain. But if you don't want to see it here on the screen also, then before B19, that is FV, you put a minus sign, sir. So if future value is negative, the present value will be automatically positive.
Tarunji,
Yes, sir.
how to copy this formula? I'm trying but not able to copy this formula.
Okay, like this, in E19, I have copied like this, you're talking, sir? Or copy down here. Hello? Sir, there are two things. Probably
Yeah, E19.
E19, right? E19 is just to display the formula. I'll tell you that also. Just give me one moment and I'll tell you.
Please.
So first I will copy this down. I'll select this and press Ctrl D. It will be copied down and then alter equal to make a sum total and see the same answer 20227, 20227. Now, anytime if you want to see formulas, then you can press Control and tilde. Control and then tilde. This tilde is adjacent to numeric key 1 or below escape key. Control and tilde. So when you press Control and tilde, see, instead of showing amounts, now the cells are showing formulas. And then you again press Control and tilde and all formulas will become amount. Control tilde, formula, Control tilde, again amount. But one more thing, probably even without doing this Control and tilde, I have typed this formula over here because I converted this formula into text. And for that, I simply put this quotation mark sign at the beginning of the formula. You know, if I remove this, it will work as a number formula, but I put this sign so that Excel treat it as a text and not as a formula and display it as a text. But anyways, I wanted to show you both things at the time, amount as well as formula. That's why I'm doing this. But when you work on Excel sheet, you can simply use control. Yeah. Right, sir?
What is tilde?
It's sign, sir. It's, yeah, it is just below the escape sign on your keyboard, or maybe adjacent to numeric key 1, hyphen sign and tilde sign are there. I don't know in English language how it is used, but on your keyboard, just below the escape key or just to the left of numeric key 1, 2, 3, 4, it may be there with this sign, hyphen sign.
Yes.
Got it, sir?
Yes, sir.
Okay, thank you, sir. So this is how you can calculate PV using the PV function. Now I'll tell you a third method also, and believe me, it is the fastest one to calculate sum of present values. And in future, we'll be using that only. In all our future questions, we'll be using that, and that is NPV function of Excel. If I use NPV function of Excel, look how will it work. In NPV function, I'll simply type, equal to NPV, bracket open. and then rate, which is 10%. Then comma, value 1, 5,000, comma. See, value 2 is in bold letters, 6,000, comma. Value 3, 7,000, comma. Value 4, 8,000. No more values thereafter. So I'll close bracket. Press enter and the same answer, 20227. Look here. And plus minus sign problem is also not there. But in fact, rather than typing all these amounts, I can simply give a cell reference also. So I'll just do one thing, that I'll type NPV equal to 10%, comma, and then I'll go here to 5,000 and select it 5, 6, 7, 8, B19 to B22 and bracket close. Equal to NPV bracket open 10%, comma, select the range of cash flows 5,000 to 8,000, B19 to B22 in my case, press enter and get the same answer. So I'll just copy this formula so that you can see it simultaneously. Any doubt to anybody? Even if a small thing is there which is bothering you, just feel free to ask it, sir. Once everybody is at par and once our foundation is strong, then we'll run.
Tarunji,
Yes, sir.
in my table at C19, the numbers are in red color. So I can see in your system it is in black color. So how we did that?
Oh, sir, because it is negative, na? So you
No,
just
not negative. It is only in red color. That's it.
have you put a minus sign over here?
No, not yet.
You put a minus sign, the red color will go away.
Okay. Got it. At the beginning of the formula?
Yeah, at the beginning of the formula also it will work, but precisely at the future value, FV.
PV.
FV. Like once you type double comma and then you give reference for FV like B19 here.
Okay, B19. Got it. Got it. Noted. Fine, sir.
Thank you. Sir. Okay. Most welcome, sir.
Thank you.
Most welcome, sir. Vishwanath, sir, is it fine? Have you done it, sir? Okay. So now you're okay. Let's interpret this and then we will solve one question. What is 20227? A bond which is expected to give 26,000 rupees to you in future. If I make a bare sum total of all these four cash flows, my future benefit is 26,000. Present value of future benefits is 20,227. And this is the fair value of the asset. So whenever you want to calculate fair value of any item, estimate its life, estimate future cash flows, calculate present value of future cash flows, make a sum total of present values to arrive at current fair value. Current fair value is 20227, sir. What if this bond is available in the market at 18,000 rupees? Type your answer, sir. Will you purchase it, sell it, or do nothing? What if this bond is available in the market at 18,000 rupees only? Will you buy it, sell it, or do nothing?
Buy,
So we'll sell it.
Okay.
buy it, sir. Buy it.
Okay. Two, three more people are left to answer it, sir.
Buy it, sir. Buy it.
Buy.
Buy it.
Right? Okay,
Yeah.
fantastic. Because the fair value is 20,000 and actual price is just 18,000. So it is available below the fair value. So it's better to buy it. On the okay, if I buy it for 18,000 rupees now, then you know what will happen? My net benefit will be, so I'll buy it for 18,000. My net benefit will be 20,000 plus this. My net benefit will be 2227 rupees. You know, in finance, this 2227 is named as NPV. But in Excel, they have kind of created a confusion that in Excel, they use NPV function. You know what NPV function is doing? NPV function is calculating present value of all future cash flows and making a sum total of all those cash flows in one single shot. But NPV function does not consider cash flow which occur at year 0. This is very important that in NPV function, when you select a range, Excel assumes that the first cell is first year. If you are going year by year, then first cell is first year. Second cell is second year. Excel assumes this by default. So if I eliminate this 6,000, say I delete this 6,000, then PV function is giving me answer of 15,000 rupees, while NPV function is giving me answer of 16,000 rupees. You know why there is this mismatch? PV is giving me 15,000. Suppose there is no cash flow at second year, so I deleted it. PV is giving me answer of 15,000 and NPV is giving me answer of 16,000.
NPV is considering that the third year is second year and the fourth year is third year.
Perfectly. Perfect, sir. What do other people say?
Right.
Right?
Right.
Yes. So Shubhamji and Amardeep sir has answered it rightly. Then Excel is considering that second cell is blank, so 7,000 is second year and 8,000 is third year. So if this is the situation, then better to put here a 0. So at least Excel says that yes, there is something in second year. So second year is 0 and third year is 7,000. Be careful about it if any such situation arises. This gives us one more thing, that in finance, when you say NPV, the formula for NPV in finance, not in Excel, in finance, NPV is equal to present value of inflows minus present value of outflows. So in finance, I will say NPV is equal to my present value of all future inflows is 20227. And if the bond is available for 18,000, then my initial outflow is 18,000. So that way 2227 is my NPV, and that NPV is actually positive. And in investment decision, if NPV is positive, then we accept the proposal. This is how it happens. NPV is positive, there is a net benefit, you accept the proposal. NPV is negative, there is a net loss, you reject the proposal. But in Excel, it does not consider 0 years outflow. So what Excel is calling NPV is actually just present value of inflows and not NPV. Right, sir? They name it as NPV, but it is actually just present value of inflows. Okay. Now, let me tell you one more thing. I will insert here one row and I'll say this is year 0. And here I'll buy it for 18,000. Now, answer my one question, sir. If I'm able to buy this bond at 18,000 rupees, then my realized rate of return, will it be 10% or more than that? or less than that?
More than that, sir.
More than that.
More than that.
Okay, we have got two answers.
More than
Praveen
that,
sir and
sir.
Sanjeev sir.
Yes. More than that, sir.
Yeah, we have got answer from your side, sir. Shubhamji is also saying more than that.
More than that, sir.
Total 3 people answered.
So can you just repeat your question again?
Yeah, sure. If I'm able to buy, do you know fair value of this bond is 20,227. But if I'm able to buy it at 18,000 only, then my realized rate of return, will it still be 10% or more than or less than 10%? Vishwanath sir is saying more, Sanjay sir is saying more. Okay. Atul sir, Anju ma'am, and all other people, Rajesh sir. Okay, yes, exactly. It will be more than that. And you know, a beautiful thing, how what exactly will be rate of return? There is one ready-made function in Excel which is named as IRR, internal rate of return. Shubhamji, you must be able to recall that when we calculate internal rate of return, we do trial and error and then interpolation. And that trial and error becomes a hell many a times. Keep on trying various rates.
Yes, sir. Yes, sir. Ultimately, then IRR is zero.
At IRR NPV is zero. Exactly. So that must always have troubled you as a student. Oh my God, this IRR thing, I need to try so many rates. And teachers used to tell various shortcuts to guess the rate. But here in Excel, the beauty is you simply type equal to IRR, bracket open and select the whole range, right from 0 year, not from first year, and bracket close. Equal to IRR, bracket open, select the range of cash flow from 0 year to last year. Mind it, in NPV, the first cell selected is assumed to be first year. In IRR, the first cell selected is assumed to be 0 year. And then press enter. And you know, I can give you more accurate answer. Just give me a moment. I'll type control 1 here, and in control 1 percentage format up to 4 decimal points. Suppose I want this answer. So 15.1553. What you did is equal to IRR, bracket open, select range, bracket close, press enter, and you get IRR. 15.15% you will be earning, sir. So this is the thing. Now let's, we have interpreted the answer that if a bond has a life of 4 years and these are the cash flows, and if I want to earn 10% rate of return, then the bond should be valued at 20227. If it is available at a price below this price, then definitely go and buy it. If it is available at a higher price, then you are the bond holder, then better to sell it. Okay, now you need to do one question, sir, so that we can make it sure that you are able to apply these concepts now. Question number 2. And you will have to solve it with all 3 methods. Number 1, you calculate discounting factor. Number 2, you use PV function. Number 3, you use NPV function, sir. Calculate fair value of a bond having face value of ₹1,000. So that can be considered as the redemption price. Face value is 1,000. So let's assume that it is redeemable at par. Maturity of 5 years and the coupon of ₹120 per annum. If the desired rate of return of investor is 14%. Without solving this, don't solve it and tell me, should the fair value be at par, premium, or discount? Fair value of this bond will be at par, premium, or discount. Type your answer, sir. Sanjay sir, what do you think? Right. Discount. It will be at discount, because one of the things over here is value is equal to performance upon expectation. It is the performance of company and it is the expectation of investors. So here the company is performing 12%. You know how? 120 rupees coupon it is giving on 1000 rupees. So company is giving 12% interest. An investor is expecting 14% interest. And that's why I can definitely say that expectations are more and therefore the value should be less. Now I request all of you to solve this question with all three methods. And you have maximum 5 minutes of time. Your time starts now, sir.
Hello.
Yes, please.
Hi, Tarun.
Yeah.
Tarunji, sorry, but I unable to understand how to solve this question 3.
Okay.
So,
I'll tell you, sir.
yeah,
So let's just do one thing.
my sincere apology, I'm not able to understand.
No, not at all, sir. Not an issue. Question 2 or 3 it was. 2, 3. Oh, it's 2, sir. Not 3.
2.
First we need to solve 2 and then we'll come to 3 also. So 5 years table I'll have to make. So the first thing for valuation is you estimate life. Sir, later maybe in the next week's session, you will learn that there are three approaches of valuation. One is income approach, one is market approach, and one is cost approach. Income approach, market approach, cost approach. What is income approach? You estimate. What we are studying is income approach. We are not studying market approach and cost approach. Estimate life. Here it is 5 years. Estimate cash flows over life. So 120 rupees coupon you will be receiving each year. And then in the last year, you will be receiving 1000 rupees of redemption price plus 120 rupees of coupon. So estimate life, estimate cash flows, and now you have to calculate present value using present value factor or whatever way you want to do it. And then make a sum total. So it will be 1 divided by 1.14 raised to the power 1. And the PV will be this multiplied by this. And then I copy it down and then I say alter equal to. So 931 will be the answer. And if I use PV function directly, then I'll say equal to PV 14%, number of period, 2 commas, minus sign 120. And then copy it down, alter equal to, I can remove this. And if I do it using NPV function, so it will be NPV 14%, comma, this whole range. And enter.
Tarunji, can you repeat PV function?
Yeah, sure. In PV function, sir, what I'm doing is, I'll tell you. So I start with equal to PV, bracket open. And first thing it is asking is discounting rate. So question says investors' desired rate of return is 14%. So this is not the interest rate I am receiving. This is the rate which investor desires. He wants to earn 14%. Then it is asking number of period. So I give cell reference A35. So that when I copy it down, it automatically becomes second year, third year, fourth year, fifth year. Then I will type 2 commas. You know why? Because I want to skip PMT. I just want to do it one by one. I don't want to use the PMT function. And then for future value, first I type a minus sign. And then I click this 120. This is the future amount.
Yes, sir.
And close bracket and press enter. Once I do this, thereafter I can simply select it like this, including 105 and Control D.
Okay. Got it.
Right, sir.
तरुण जी
Right, sir. Yes, sir.
तरुण जी एक बार पीवीएफ का फंक्शन दिखाएंगे क्या
Sure. Sure. So this PVA function is like, I'll just copy it upside. So this is, the first one is like this.
1 divided okay.
Done it, sir?
Just 1 minute.
Sure, sure. Take your time. Anybody has any problem in this? Just feel free to ask, sir. Sanjay, sir? Got it, sir?
Yeah, doing it.
Doing it? Okay, take your time.
Yeah, because I'm not very like fast at Excel, so it is taking time.
Yes, sir. Yes, sir. Take your time, sir. No
Right.
issue. Anju ma'am, have you done it? Doing it? Okay. Jatin, sir?
Doing it.
Okay. Sure, sir. Sanjeev, sir, probably you have done it.
No, I'm trying it.
Trying it?
Yeah.
Okay. Take your time, sir. Once we are able to do it on Excel, then in examination, it will become very fast. Otherwise, case studies eat up a lot of time in exam. If you do it on Excel, it will save your time. And in real life also, all the assignments will need Excel. Amardeep ji, have you done it, sir?
Yes, I have done it.
Okay, fantastic. So you and Shubham ji, you two are the fastest one. Vishwanath sir, have you done it? Okay, Rajesh sir has also done. Praveen ji, are you getting it, sir?
Yes, sir. Doing,
Oh.
sir, doing.
Oh, you're doing? Fantastic. Okay, Jatin sir has already done it. That's good. Feel free to ask even a very simple, basic thing also. I'll be more than happy to assist. Don't be shy of asking anything. Even if you can do it with NPV function alone, that is also fine because we will stick with NPV in all future questions because that is, the fastest and the easiest one.
Tarunji, can you just give me demo for the PV function again, like including the value?
For sure. So let's delete this and I will do equal to PV bracket open.
Just show the, yeah, just give me the PV first and then the other functions like
Yeah, sure.
PVF and PV. Yeah, because like yeah, on calculator I'm able to do it, but not on the Excel.
Okay. So you just do it with, you can do it with me. Equal to, probably the right sheet is shared. Yes, it is. Equal to PV bracket open and then rate 14%. Oh, I'm sorry. 14%. And then a comma. Now, after the comma, it is asking number of periods. So I'll click at A35. Probably you also have A35 or the cell containing year 1.
No, I have A36.
Okay. So you click A36, sir. Let's do one thing. We'll be at par.
Sorry, is B36, sorry.
B36 you have?
Yeah.
Okay. So equal to PV bracket open 14%, comma, and then click 1. So with you, it is B36. Okay.
Yeah.
And then comma. So now you can see PMT is in bold letters, sir.
Yeah.
But I want PMT.
Yeah, PMT is in bold letter. Yeah. So I'll put 2 commas.
2 commas. So it will be skipped.
Yeah.
Then 1 minus sign so that our output is positive.
Yeah. And in my case, it comes as B40.
B40, B36 it must. It's C36 in your case, probably.
So yeah, C30.
Sir, my question.
B and then the.
You just click it, sir. It will automatically come. You need not to type it. You know,
Okay.
you just click 120. You type 1 minus sign and you click 120.
Just a second, I'll do it on mine.
Yeah.
So
My query in hello.
Yes, sir.
Sir, why did we put 2 commas?
Because we want to skip PMT. PMT हम तब use करेंगे सर जब annuity हो. Annuity means equal amount की series हो. यहाँ पर last amount equal नहीं है. Last amount is 1120.
6 double comma and then C40.
Don't type cell reference, sir. Just click that cell and it will automatically capture it. Like after 14%, you click wherever 1 is written. So it will capture that. Then 2 commas minus sign. And click 120. First 120.
Just a second, I'll do it.
Sure.
Last one is still it is not coming.
Just I will do one thing for you.
Yeah.
I'll also change my cell as per your requirement. So this is one row I'm inserting.
Yeah.
This
First year is in 36. Yeah.
Right. B36. No, you have B36 year
No,
in
the year starts from A column.
A column.
Yeah.
Okay. It is A36 with you, no?
Yeah. And B is the amount. Okay. PVF is on the C.
So equal to PV. Sir, just do what I'm saying.
Yeah.
Even you do need not to look at the screen. Equal to PV bracket open 14%.
Yeah, 14%.
Comma. Then click. Just move the mouse.
Yeah.
And click this one. This cell anywhere in the cell.
Okay.
So it will automatically capture that A36.
Right, it is captured. Okay.
And 2 commas thereafter.
Yes. 2
1
commas.
minus sign.
Yeah.
And then click 120. First 120.
First 120. Okay.
It will automatically take B36.
Yeah. Okay. It's coming. Okay.
You can share your screen also, probably, then I can see, or then close bracket.
Yeah. Just a second. I did something. Yeah. I close the bracket and then enter.
Yes, and you'll get 105.
Oh, still not coming. Can I share my screen?
Yeah, I think you have that facility. Otherwise, I will make you your.
You cannot. Okay.
Wait a minute. Wait a minute. I will. Uh, just a minute. I'll in one of the settings. The option is there. Just a second.
Got it. Got it. Got it. I think I forgot to put equal sign. That's why it was not coming up. I could do that. Yeah. Done it. Done.
Okay.
Then I have to pull it down.
Okay. Yeah, pull it down. Yeah, that is the best way.
So, yeah, things are coming now. Thank you. Thank you. Thanks.
Most welcome, sir. All right, everybody. Now let's move. So at least with NPV function, you make sure that you can do it. Rest of the things, if it is not happening, it's fine, because NPV function alone can handle many things. Right. So now we are coming to question number 3, sir. It's a different question this time. Question 3, again, we have to make a valuation. And sorry. In question 3, it is written that calculate fair value of ₹1,000 face value perpetual bond. Perpetual bonds means irredeemable bond. Means the principal amount will be paid only at the time of winding up of company and not before that. Do we have perpetual bonds in reality, or is it just theoretical? Is it just theory? Type your answer, sir. Do we have perpetual bonds in real life, or is it just in theory? If you don't want to answer a question, or if you don't know the answer, you will have to type pass. You cannot simply let it go. Either you answer it or you type PASS. You know, this chat is downloadable, and at the end of the session, it can be analyzed that who were participative and who were not. That will be taken as an attendance by IBBI, sir. Okay. Come on, everybody. Either you type a pass or you type an answer. No negative marking is there. Even if you answer it wrong, nobody is going to judge you. Right, sir. When we read the Companies Act now, probably it is rule number 18 of issue of shares and debenture rules. And rule number 18 says that a company can issue only debentures and bonds which may be redeemable maximum up to 10 years. For preference shares, it is 20 years, but for debentures, it says 10 years only. But if it is for infrastructure funding, it can be maximum for 30 years. But when I read section number 1 of the Companies Act, it says that banking company, electricity company, insurance company, and special act company. To these companies, Companies Act is applicable only to the extent their respective act is silent. So if there is a conflict between Companies Act and Banking Regulation Act, then the Banking Regulation Act will prevail. Otherwise, Companies Act is also applicable to a bank. But Banking Regulation Act actually allows a bank to issue perpetual debenture. So if a company which is running a bank can issue perpetual debentures, and at least 10, 12 such issues are there in the life. State Bank of India has issued perpetual bonds. Yes Bank has issued perpetual bonds for their tier 1, tier 2 capital. Banks actually issue perpetual bonds, and they are reported in the market also. Like last month, Yes Bank perpetual bond. It was so risky that investors were expecting 18% per annum return on that. 3 years back, State Bank of India issued 81, that is perpetual bond of some 2000 crore rupees. At that time, it was fully subscribed by Yes Bank only. So yes, perpetual bonds are there, but yes, I will say they are rare. Number two thing, whatever we are going to learn through this question, it can be used for valuation of equity shares also, because equity shares are always perpetual in nature. So if any company is expected to give constant dividend forever, the learning of this question can be applied to valuation of equity share also. So now you have to calculate fair value of rupees 1000 face value perpetual bond. If coupon is rupees 90 per annum and desired rate of return is 10% per annum. Look, without making a calculation, can you tell me par, premium or discount, sir? This bond should be quoted at par or premium or discount or pass.
Premium.
Okay. Amarji, Anujji, no, sorry, Rajesh ji and Jatin ji. They are saying at premium. Okay. Praveen ji and Vishwanath ji is saying at discount. Actually, it will be quoted at discount. You know why? Because company is paying just 9%. Look here, 90 rupees on 1000 rupees is 9%. Company is performing 9%. And investors are expecting 10%. So expectation of investors is more than the performance of the company. Higher the expectation, lower the value. And you know, if I try to solve this question by making a table, then I'll have to make table for infinity years. But thank God, there is a shortcut formula and it is present value of perpetuity. This time it is not present value of a single amount, it is present value of perpetuity. Perpetuity means an annuity which never ends. It is installment divided by rate. So in simple, it is A divided by R. This is not A upon 1 plus R raised to the power n. This is A divided by R, full stop. So if I applied here, A is 90 rupees, amount of one installment forever, divided by desired rate of return is 10%. So fair value of this bond should be 900 rupees. But there is a question. Why should I believe that this formula is giving me a right answer? I doubt it. I question it. This is not a correct formula. Now I'll give you an Excel solution of this question. You need not to do Excel solution with me. You just observe it. That if I want to create a table and then calculate present value at the rate of 10% of all future cash flows, then you know, first of all, I'll have to make a table for infinity years. First thing is, so home tab, I'll go and then I'll say fill series column. You know, I cannot make a table for infinity years. Reason being, there are only 10 lakh rows in Excel. So I'll just make a table for a very long period of time. Maybe 100, 200, 150 years. I prepared a table for 150 years. And amount I'll be receiving is 90 rupees. So 90 rupees, I'll double click it here. Dragging down will be costly. I double click it here and 90 rupees I'll be receiving for 150 years. I'll be receiving for infinity years, but I'm considering it only up to 150 years. Then to calculate present value equal to PV, bracket open, 10% in PER, double comma, minus sign, 90, enter. 81.82 is present value. Sir, 81.82 is actually present value of first year's cash flow. I need to calculate it for infinity years. So I double click it here And look, present value is reducing. 13 rupees in 20 years, 2 rupees in 37 years, 54 years, 52 paisa. It has gone down to 0 rupees. If I am considering only 2 decimal point, then in 103 years, whatever amount I receive, its present value is 0. And that's why I need not to make a table up to infinite years. Just up to 150 years it is, and I make a sum total by alter equal to, and see the answer, 900 rupees. So if I disbelieve the formula, I can create a table for very long period of time and can calculate sum of present value of all future cash flows. And that will give me 900 rupees of answer. Right, sir? So we have cross-checked that this formula is correct. Just keep in mind this one. Present value of perpetuity is A divided by R. Installment divided by rate. The next thing now is calculate now a next question. What is fair value? Value today is sum of present values of future cash flows. So that's what we are doing. Calculate current fair value of equity share. Okay. If face value is rupees 10, we'll have a tea break, sir. Don't worry. Probably you might have been tired. After this question, we'll take a break. And lunch break, we will have around 1:15 or 1:30 around. So face value is rupees 10. Dividend expected at the end of first year is rupees 4 per share. Dividend expected at the end of first year is 4 rupees per share. Just a second. And growth in dividend forever is 10% per annum. Okay. Just a second. So this time the cash flow will not remain constant. It will grow at a constant rate of 10% per annum. Right, Shubhamji, your answer is correct. Shubhamji, you just do one thing. You try that perpetuity thing I did in Excel, because you will find us to be slow. So to utilize on your time, you can do that perpetuity thing in Excel meanwhile. Expectation of equity shareholders is 20%. So that is the discounting rate. And this dividend will not be constant. It will grow at the rate of 10% per annum forever. So now this is not a perpetuity, rather than it is a growing perpetuity. One is a perpetuity where all cash flows are constant. And other one is the growing perpetuity. That is, the cash flows will grow at a constant rate. And there is a formula, and that formula is named as Gordon's model. You can also name it as growth approach. And you know, the formula looks like this. Present value of not perpetuity, but present value of growing perpetuity. It is equal to P0 is equal to A1 divided by R minus G. Look here, perpetuity formula was A upon R. Here also it is A divided by R. But in the denominator, you are also deducting growth rate. You are not deducting growth rate because you like to deduct it. There is a proper derivation behind this formula. But just to, easy to memorize, I'm telling you, this is A, this is A, this is R in the denominator, R in the denominator. But in the denominator, you need to deduct growth rate. If growth rate is 0, then G will become 0 and this formula will become actually A upon R. Because if growth rate is 0, it is the constant perpetuity, not the growing perpetuity. So the formula will become A upon R. Notice one more thing. Here I put just A because first year A, second year A, third year A, fourth year A. But in this formula, Gordon's model formula, A1, A2, A3, A4, every year it will be different. That's why I put A1. So when I put first year's amount over here, I get value at the beginning of first year. When I put first year's amount in this formula, I get value at the beginning of first year, that is 0 year. Beginning of first year is 0 year. Look, here A1 is 4 rupees. You know why? Because the question is saying at the end of first year it is 4 rupees. Divided by cost of equity is 20%. Because expectation of equity shareholders is 20%. Minus growth rate is 10%. So that will be 4 divided by 10%, that is 40 rupees. Keep in mind, don't put here 0 years amount. Put here first year's amount. And first year's amount is A1. And that is 4 rupees upon discounting rate minus growth rate. If you are doing this calculation in Excel, don't forget to put a bracket in denominator. Because if you don't put a bracket in denominator, and in Excel, I'm saying in Excel, if you do this, and if you don't put a bracket and type it like this, then Excel works on BODMAS. First it will divide and then it will deduct. So your answer will become wrong. So while doing it in Excel, put a bracket in denominator. Again, if I don't trust this formula, I can prove it. Look here. Again, I'll make a table for a very long period of time. Year, amount, and present value at the rate of...
Your Excel is not visible.
Oh, sorry. Yeah, I'll have to share it. Year, amount, and present value at the rate of 20%. So here I go year, and then I home tab, fill, series, column, say 140 years, whatever. Randomly, I'm taking a very long period. And first year it is 4 rupees. And second year it will be 4 rupees into 1 plus growth rate. 4 rupees into 1.10, that is increase it by 10%. Multiply by 1.10 means increase it by 10%. And then keep on increasing at the rate of 10% forever. This way, in 140th year, dividend will be 22,68,001 rupee per share if it keeps on growing at that rate. 22 lakh rupees dividend per year. Then for present value, I'll be using the regular function 20% number of period. So it is 3 rupees, and then just I copy it down. The present value has gone 0 in 76th year itself. And 22 lakh rupees per share you are receiving. But after 140 years, so its present value is 0, it's worthless. And see, answer 40 rupees. Hence proved. If you disbelieve the formula, I have proved the answer. Even if you believe in formula, but if you don't want to use it, you don't want to use the formula, then also you can make a table for a long period. Otherwise, the formula is very simple. First year's amount divided by R minus G. Just beware of one thing, that if A1 is not given, then A1 will be equal to A0, that is 0 years amount multiplied by 1 plus growth rate. Suppose question would have said that current dividend is 4 rupees or current dividend is 8 rupees. Current dividend, not first year's dividend. Current dividend is 8 rupees and growth in dividend is 4%. Then I'll say,
Your screen.
oh, sorry. If the question says that current dividend is 8 rupees, that is A0, and growth rate is 4%, then first I'll have to calculate first year's dividend 8.32 and then put it into the formula. Right, sir? So you just do one thing. This is one example.
Sorry to interrupt. Your screen was not visible. So can you please repeat that?
Yeah, it's very simple. In the formula, you need to put A1, that is first year's amount. Suppose first year's amount is not given and 0 years amount is given. Current dividend is given, not first year's dividend. So you just multiply it by 1 plus growth rate. So suppose 0 years dividend is 8 rupees and there will be a growth of 4% in dividend. So first year multiplied by 1.04 and therefore first year's dividend will become 8.32. Right, sir? Like in this example. Try to solve this example using the formula, not Excel. Shubhamji, meanwhile, you can try it on Excel also. That will utilize your time. Look, guys, this is current dividend, huh? Mind it. So this is not first year's dividend. And in formula, we need to put first year's dividend. So you have to add growth to it.
Yeah, 5.3 will be the answer.
5.3 will be dividend for first year. Perfect. Now they are expecting 15% return. And how do I know that I need to apply Gordon's model? How will I know in a question that I need to apply Gordon's model? Growth rate is given. If growth rate is given, and that's perpetual in nature, dividend is perpetual in nature, and growth rate is given. So you need to apply Gordon's model. First year's amount divided by the discounting rate, that is desired rate of return of investor minus growth rate. So 58.88 is the right answer. Okay, let's take a break for 10-15 minutes, kind of tea break. And it's 11:35, 11:36 in fact. So 11:50 a.m. we will resume.
Okay,
Right.
thank you very
Now
much. Okay,
yeah,
thank you very much.
most welcome. Okay. Let's start it again. So I hope you got this answer. 58.89. Right?
Yes, sir.
Okay, fantastic.
Yes.
Now, the next thing that we need to do. Hello. Yes. So the next thing is, the assumption underlying this model is that growth rate is constant right from year one. So first year's growth rate, in the last example, first year's growth rate in dividend is 6%. In second year also growth rate is 6%. And then it will keep growing at the rate of 6% forever. Growth rate is constant. This is the assumption. If the growth rate keeps on changing year by year, then actually this model will fail. And if this model fails, it doesn't mean you cannot solve the question. If this model fails, you can make a table for many years and calculate present value of sum of various cash flows. What if the question says that for first 10 years, growth rate is variable, keeps on fluctuating. But 11th year onwards, growth rate becomes constant. Now here what I can do is, I can either make a table for 100, 200 years and not apply the Gordon's model formula at all, because for first 10 years, the growth rate is actually constant, variable. Or other thing I can do is, I can make a table for 8 years, 10 years, because for first 10 years, growth rate was not constant. And 11th year onwards, I can apply Gordon's model formula, because 11th year and thereafter, growth rate has become constant. So that will be named as two-stage dividend discount model. Why it is named as two-stage? Because first stage is variable growth stage and second stage is constant growth stage. So let's see one such situation. But before that, I'd like to tell you one more thing. Here in this question, if I put first year's cash flow in the formula, I get value at the beginning of first year. That is year 0. But here in this formula, if I put, say, 6th year's cash flow, then I will get value at the beginning of 6th year, sir. Beginning of 6th year is actually end of 5th year. So when I put A6, I'll get P5. When I put A1, I get P0. So when I put A6, I'll get P5. So if I put AN, then I'll get P n minus 1. Right? So why do I need to do it like this? I'll tell you one reason behind it. Just a second. Huh? It's a two-stage valuation model. And what are the steps for calculation? Calculate present value of cash flows under variable growth period, say 5 years. Then calculate terminal value using the following formula. Rather than writing A6, what is FC, FF, FC, FE? That we will discuss later. So just to keep it simple, A6 upon R minus G. I'll calculate terminal value. You know what is terminal value? Value at the end. So if I assume that I will hold this share for 5 years, and at the end of 5th year, I'll sell it out. So I can apply the Gordon's model formula from 6th year because the growth rate has become constant from 6th year. So I'll do A6 upon R minus G to arrive at P5. And this P5 may be named as terminal value. That is the fair value of share at the end of 5th year. And then calculate present value of this terminal value also. And make total of first 5 years present value and the present value of terminal value. Make sum total of first and third step to arrive at the current fair value. Probably it is not understood. So we will solve one question and then definitely you will get it, sir. So here we have question number 5. Question number 5 says that Z Limited is foreseeing a growth rate of 12% per annum in next 2 years. The growth rate is likely to fall to 10% for the 3rd and 4th year. Z Limited is foreseeing a growth rate of 12% per annum in next 2 years. Okay. The growth rate is likely to fall to 10% for 3rd and 4th year. So for the 3rd year, growth rate will be 10%. And for the 4th year also, growth rate will be 10%. Don't misunderstand it as the dividend is falling. It is the growth rate which is falling, but dividend is still growing. After means from 5th year, the growth rate is expected to stable at 8% per annum. So 5th year onwards, growth rate will become constant forever. So from 5th year, you can apply Gordon's model formula. If current FCFE, the full form is free cash flow to equity. What is free cash flow to equity? What is free cash flow to firm? How do we calculate it? That we will discuss later. You just treat it as cash flow. This is A. This is free FCFE actually means A, amount. But mind it, this is current FCFE. But for calculation of fair value, I need cash flow from 1st year. Try to recall. What is fair value today? It is sum of present value of all future cash flows. That is 1st year to infinity year, whatever cash flow you get, calculate sum of present value, that will be fair value. This is A0, sir. This is A0. This is 2.5 crore rupees. An investor's required rate of return is 16%. So that is the R formula. In formula, R is 16%. And you know the growth rate will be, G will be 8% in the formula. Find out the value of Z Limited as of date. Now I request you to keep open the question in PDF file I have shared with you. Either you can keep it open in your mobile phone or you can mail it to yourself and open in your laptop also. So I am switching to Excel sheet.
Growth rate is?
For first 2 years, 12%.
Okay,
then for next 2 years, 10%. But the constant growth rate is 8%.
Got it.
So either you take a picture of this screen or better you open your PDF file, sir. look here. How will I solve this question? This is question number 5. So I'll solve it in 2 steps. And step number 1 is, we'll consider here, cash flows from year 1 to 5. So I'll make a table. I request you also to make the table from A46. And I'll make table for 4 years. Why? Because for first 4 years, growth rate is variable. So Gordon's model formula cannot be applied. So we will solve through table. But for remaining years, growth rate is constant. So we will not continue table for 100, 200 or infinite years. Rather than from 5th year, we will apply the formula. Now FCFE, free cash flow to equity. And look, the first FCFE will be 2.5 crores multiplied by 1.12. You know why? Because 2.5 crore is current FCFE. I need first year's FCFE. So I need to apply 12% growth to it. Then I multiply it by 1.12 again, because in the second year also growth rate is 12%. Then I multiply it by 10%, because in third year 1.10 I mean, because in third year growth rate is 10%. Then in fourth year I'll multiply again by 1.10, because growth rate is 10%. And then I will use NPV. I told you, we will be using only NPV function because it is the simplest one to use. Equal to NPV bracket open at the rate of 16%, comma, select the range, close bracket. See here. So try to achieve this, sir. Once you are done with it, then we will move for the next step. Do it yourself. Feel free to ask doubts. Done? Okay. Very nice. Why have you not taken 5th year? Yes. Atulji, from 5th year, I'll be able to apply formula. So 5th year onwards, dividend will be taken care by the formula. I can avoid formula and I can make table not only for 5th year, but say for 100, 200 years, I can continue to make the table. But that's not the good way of solving it. 5th year growth rate is constant. So from 5th year, formula will be applicable. What is the lunch time? Around 1:15, 1:15, 1:30. Amarji, Shubhamji, you can try to solve the question for the second step also. Sanjay sir?
Yes.
Got it, sir?
Yeah, I'm doing it. The first stage I'm doing it, and then second I'm doing it.
Second step, I'll tell everybody.
Right.
Okay.
I
First step, if you have done,
yeah, I'm done.
then let's move for second step.
Right.
So step 2, cash flows, which are cash flows from year 5 to infinite. Ultimately, I have to consider all cash flows. First 4 years will be considered in table, and 5th year onwards in formula. So first I'll have to calculate 5th year's amount. That will be 4th year's amount multiplied by 1.08. Because now the growth rate is 8%. Now try to recall when I put A1, when I put A1, I get P0. When I put A4, I get P3. So when I will be putting A5, what I will be getting? When I put A5, I'll be getting what? P4, P5, P3, P6, what?
P5.
Okay.
Can you repeat the question?
Yeah, it is there in chat box also.
Not getting the question. Sorry.
Okay. My question is, in the Gordon's model formula, when I put A1 upon R minus G, I get P0.
Right.
So when I'll be putting A5 upon R minus G, what I'll be getting?
A4.
Not A4.
I mean P4.
Okay. That is your answer. Shubham ji has already answered. What do other people say, sir? Okay. Praveen ji has also answered. Come on, everybody. At least try to guess it. There is no negative marking here. Or at least say pass. That's make a habit. Look, sir, if I put A6 now, I get value at the beginning of 6th year. That is at the end of 5th year. So when I put A6, I get P5. So definitely, if I put 5th year's amount over here, I'll get value at the end of 4th year. Okay. So I'll get value at the end of 4th year. And therefore, now I'll calculate P4. And P4 is equal to A5 divided by R minus G. Right? So this is A5 divided by, don't forget to put a bracket in denominator, R. In this question, R is 16% minus G. So 5th year onwards, growth rate is 8%. A5 upon R minus G, this will give you P4. fourth year's value, terminal value, 51 crores. So if you hold the company for 4 years and then you sell it out at the end of fourth year, then you will be able to realize 51 crore rupees. This is named as terminal value. And now I'll have to calculate PV of P4. You know, what exactly is P4? It is accumulation of cash flows from year 5, year 0, 1, 2, 3, 4. And this is 5, 6, 7, 8, 9, 10, infinite. So 5 to infinite, whatever cash flows are there, if those cash flows are accumulated at fourth year, it becomes P4. So P4 is accumulation of future cash flows at fourth year. But I want to accumulate all those cash flows as of today. So I'll have to calculate present value of this P4 also, because it is at fourth year and I want it to be at 0 year. So I can again use NPV formula. NPV discounting rate is 16%. And when I put first comma, it is asking me to input value 1, but I have value 4, that is fourth year's value. So I'll put 4 commas. And once I put 4 commas, I get to put here fourth year's value. 4 commas means now fourth year's value. And then I click 51. 51 is P4. So now you don't need to use PV function. You can use NPV function for all your calculations. This is now present value of P4. You know what this 9.05 is representing? This 9.05 is representing year 1 to year 4. Year 1 to 4. And you know what this 28.29 is representing? It is representing year 5 to year infinite. Just a minute. Insert. Oh. It is representing year 5 to year infinite. Why 4 commas? Yeah, for sure. Just give me one moment. I'll tell you why 4 commas. I'll zoom it for you and then your understanding will be better. Look, sir. Here it is. When I type NPV formula and say rate is 16%, as soon as I put first comma, value 1 is in bold letters. So after first comma, whatever is typed, Excel will consider it as first year's figure. Now see, whatever I type now, Excel will consider it as second year's figure. Value 3 is bold. Value 4 is bold. When I put 4 commas, now if I give some value, Excel will consider it to be fourth year's value. And this is fourth year's value because this is P4. Now forget about A5 because A5 has already been converted into P4. And once you get P4, then you need to discount it with fourth year's factor on.
Tarun sir.
Yeah. Yes, I'm listening.
Suppose it's 100 years. So we'll have to type 100 times comma. So there should be some better formula for it.
Yeah, we have better formula, that is PV formula. Equal to PV bracket open rate NPER, at the place of NPR put 100.
Can you just do it?
Yeah, I will do it with, I was trying to stick. I demonstrate, don't worry. But I recommend that, too many formulas may confuse some people. So that's why I'm sticking to one formula, that everything let's do with NPV. But you can do it with PV also. So you do it equal to PV bracket open, rate is 16%, then number of period is 4 years. Then PMT you would like to, so see it is 28.29. Right, sir? So one can do it with PV formula also. But if we stick to one formula, life will become simple. Let's do it with NPV only. All right, guys. Now, I was telling you that this 9.05 is actually representing first 4 years present value. 28.29 is actually representing 5-year to infinity years value. So if I want to calculate P0, it will be simply sum total of 9.05 and 28.29. I need to add these two figures together, and that is the final answer. So current fair value of this company is 37.34 crore rupees. And 1 to 4 year is covered over here, and 5 to infinity years are covered over here. So now this is finally representing year 1 to year infinite. Okay. Now I'll do some cleanup work because too much of things will make it hodgepodge. Look here. This is your step number 1. This is your step number 2. And then you make a sum total of both steps present value to finally arrive at current fair value. Right, sir? Now do it yourself also and get this answer, 37.34 crores. Formulas are typed in next column, like in column D and column E. I have shown formulas also. How B53 in formula, cell number D55. Okay. Okay. B53. Yeah, I'm telling you B53, Jatin sir. So B53, okay, well, I shifted formula, na? I inserted one row, that's why it's looking like this. So don't worry.
Okay.
I will kind of again do this. Now these are refreshed formulas. Come on, everyone, just do it yourself. Then only you will get the confidence, you'll have a grip on it thereafter only. Vijayji, make me co-host with you. Amarji, please mute your mic, sir. Done? Okay, nice. Come on, everybody, just do it. It's not difficult. You know, first you simply calculated 50 years figure by adding 8% growth to it. Then this figure is divided by R minus G. Then you calculate present value and made a sum total of these two figures, 9.05 and 28.29. Once you have done it, please let me know. Okay, good. Okay, any doubt to anybody? Are we good to go? Fine. If we need to wait, please let us know. Otherwise, let's move for the next concept. In fact, I wish that you do one question yourself fully, and that too try to do it quickly. So I'll copy all data in Excel sheet itself. This is one example. Current dividend is ₹5 per share. So mind it is current dividend. 0 years dividend. Growth is 12, 8, 12, 10, 8 and 6% forever. Cost of equity is 20%. Calculate current fair value. Can you tell me for how many years I will have to make table compulsorily? For how many years I will have to make table?
3 years.
Okay. right?
सर
Praveen
इसमें
sir
तो
is
मेरे
saying
ख्याल
3
से
years.
ये हमारे 4 एट्रीब्यूट्स है ना, तो एनोवा यूज हो। ठीक है सर, ठीक है। और सर ये जो आपने 5 पॉइंट्स दिया है, फिफ्थ, व्हाई हैव यू चूजन अ सैंपल विद हुज इनकम, सर इसे कट कर देते हैं, हम 2 lakhs वाला रहने देते हैं।
Okay, we are getting some other
क्योंकि
voice. I
200
thought this is
सैंपल
out.
तो ज्यादा हो गए, पहले हम
Okay. So you'll have to make a table for 3 years, sir. Or should I keep it for your own exercise homework, or would you like to do it now? Okay, so do it now. Make a table like this, year 1, 2, 3, and then 4th year later, and then dividend, and then 3, and then you will calculate, P3, something like that. Think like this. For how many years you'll have to make table, sir? You'll have to make table for 3 years. You know why for 3 years? Because from the 4th year, the growth rate itself has become constant. When the growth rate has become constant, that cash flow may be captured by the formula. So make a table for 3 years and then calculate terminal value at the end of 3rd year. Probably it can take more time. So you just take a screenshot of this question. If you, I just need your
Yes.
opinion. Would you like to do it now or later?
आप कौन? तो
Sir, you need to mute yourself. Everybody, we are getting your personal voice over
हाँ
here.
ठीक।
Would you do it now, sir? Or should we leave it for later? You can do it later yourself. Later? Okay.
Do it now. Do it now,
सर
sir.
जो ये 6
Do it
पॉइंट
now. So, one vote for later, one for now. So we have a tie now. So do it now.
Yes sir.
Okay, do it now. $41.94. Okay, fantastic. Very good, sir.
Karu sir, unable to complete it. He stuck in between.
Sure, I'll help, sir. Let's wait for 2 more minutes and then we'll do it together. Okay, I'll tell you. First of all, table should be prepared for 3 years. Why? Because Gordon's model formula can be applied from the year where growth rate has become constant forever. So fourth year onwards, growth rate is constant. So fourth year onwards will be taken care by Gordon's model. What about first 3 years in that case? That is left. How to cover first 3 years? So I'll make a table for first 3 years and I'll say it is 5 rupees multiplied by 1.12. Okay. And then this amount should be multiplied by 1.10. And then this amount should be multiplied by 1.08. And then fourth year's amount should be multiplied by 1.06. And then I can use NPV formula for first 3 years at the rate of 20%. And then I can use again NPV formula. First, I'll have to calculate P3. So that P3 is equal to this amount divided by 20% minus 6%. And then I'll calculate present value of P3, which is equal to this amount divided by, which is equal to NPV at the rate of 20% and then 3 commas. And finally, I'll calculate P0. So that will be 41.94. So Atulji answered it fast, and Atulji, your answer was perfectly correct. 41.94.
Tarun sir, hello. Hello.
Yes, sir.
Sir, this is current dividend of rupees 5 per share.
Perfect.
We should not multiply 12% first. That is around 60 paisa, 5.6. Then it to again 0.12%, then a 10%, then 8%, and then 6%. Should not be so.
Perfect.
Should not be
Perfect.
so.
First year we multiplied by 12%. Second year is multiplied by 10%. Third year it is multiplied by 8%.
The dividend is 5.6% in first year is the end of the year.
5.6 is at the end of the first year. That's perfect.
Yes. Okay. Okay. Got it.
Anju ma'am, are you trying it? Please try to solve it because this is one of the frequently asked type, Gordon's model. And this is a simple question. So everybody must try to do this. Rajesh ji has done it. Fantastic, sir. Jatin sir has also done it. Very nice. Anju ma'am, please feel free to ask any of the point you are not getting. Okay.
Tarun sir.
Yeah, please.
When you are calculating this NPV, at 12.79 is coming. At the same time, when I'm calculating the same thing with PV, my figure is not coming the same. Can you calculate it
Sure.
PV?
For sure. So rate is 20%.
Yes.
And the number of period is cell reference. Then 2 commas. Don't forget to put 2 commas. And then this. See, these 3 figures will be there. And at the bottom, you can see the sum is.
Can you copy paste the formula?
Yeah, sure. I will. In fact, I'll show you formulas.
Somehow mine is coming as, yeah. Yes, you can leave it here. Thank you.
Most welcome.
20% is there. NPER is year.
Yeah. NPR is number of period, that is year.
NPER is year. Okay. And B67.
2 commas, don't forget to put, sir.
Yeah, B67 is
dividend.
Dividend.
Getting it, sir?
Yes, I got it. Thank you.
Okay, most welcome. Done? Okay, fantastic. Very nice. So now we know if cash flows are given and if discounting rate is also given, how to arrive at the fair value. You know, before I proceed, I'll tell you one interesting thing. Like here we calculated fair value of share to be 41.94. Suppose, let's assume that current EPS is rupees, whatever, 6. Let's say current EPS is 6 rupees. And now current fair value we have already calculated and it is 41.94. If I calculate price to earning ratio, do you know formula for price to earning ratio? Type it if you know it. Price earning ratio formula. So it is MPS upon EPS. Exactly, Jatin sir. So in place of at the place of MPS, I can put fair value also, because if market is efficient, then the fair value and market value must be same. So 41, I will do. So PE ratio is equal to MPS divided by EPS. So I'll do MPS is 41.94 divided by EPS is 6 rupees. So price earning ratio is 6.99 or approximately it is 7 times. I was telling you, there are 3 approaches of valuation that you will be taught in some other lecture, but I'm just giving you a quick idea about it. There are 3 approaches of valuation. One is income approach. So I think income approach is the best approach. It is the most logical and worthy approach. Here you have to estimate life of the project, then estimate various cash flows during the project, and then calculate present value of cash flows and make a sum total of all those cash flows to arrive at the current fair value. So it's a very lengthy job. Okay. Suppose I am making valuation of a school. So what do I do? First of all, for first 5-6 years, I will ask all the details from the school. How many number of students do you already have? They say 2,500. How many new admissions are every year? How many 12th pass out students are every year? What is the fee structure for each of the class grade? How do you charge for transportation? How do you charge for mess? That way I'll calculate revenue for each of the next 5-6 years with a whole detail. Then I'll say, how many teaching staff do you have? How many numbers for non-teaching staff? What is their salary? What is their increase in salary as per the employment agreement? How much rent do you pay? How much electricity do you pay? How much fuel charges you pay? And all detail I'll ask from them. Kind of 1 or 2 hours interview I'll take from them and extract the data, put that data in Excel sheet, and year by year cash flows I'll calculate. And then I calculate present value of those cash flows. So that's a kind of hard work under the income approach, and that's the best approach for valuation, theoretically speaking. Now, once I get the fair value, and suppose I deal at that fair value, then rest of the market will also know that this company has got a recent deal. It has issued 10% of its shares to somebody at 41.94, while its EPS is just 6 rupees. So price earning ratio of this school is 7 times. Now, if there is other school in the market and that other school has earning per share of rupees 8, and this guy doesn't want to do all the hard work of doing all this, he'll simply say, look, my EPS is 8, so this 8 should be multiplied by price earning ratio because your company is comparable to my company. So 8 should be multiplied by price earning ratio of 7 times. So 8 into 7, around 56 rupees should be fair value of my share. Now, this way of doing valuation is called market approach. You find a comparable company in the market and you use the some market multiple for that company to make valuation of your company. So that buddy has done all the hard work. You copy and paste their hard work in the form of price earning ratio, price to book value ratio, enterprise value to EBITDA ratio, enterprise value to sale ratio, and many more market multiples are there. So this is market approach. Now the third approach is actually cost approach. Suppose the company is not a going concern and therefore no future cash flows are there. Okay. And comparable market company is also not available. Then I'll go for cost approach. So I got assignment for valuation of a school. And now the thing is, suppose their income is on the lower side. So I would like to check the cost approach also. So school has got 10 acres of land, 50,000, 70,000 square feet of construction, swimming pool is also there, gymnasium is also there. So I'll appoint some land and building person and he'll calculate fair value of land. He'll calculate fair value of building. Somebody will calculate fair value of buses and other vehicles school is owning. Then I'll calculate their cash in hand, cash at bank, debtors, bank loan, etc. And take fair value of individual asset, make a sum total, deduct the liability, and then divided by number of equity share to arrive at value as per cost approach. Just to give you a flavor, it will be taught in a separate lecture. So there are three approaches: income approach, market approach, and cost approach. What we are pursuing right now is income approach. Market approach is copying the hard work of income approach. Cost approach is something different. It is totally, especially when it is not going concern, then the cost approach may be used. Right, sir? So with this, let's go ahead. Now we know if cash flows are given, if discounting rate is given, we can calculate fair value. But how to calculate cash flows? And how to calculate discounting rate? That's $1 million question now. Like here, 20% is the discounting rate. How do I calculate rate? That we will learn. But before we learn that, I'll give you one more perspective of what we have already done over here. So to give you that perspective, I will have to, just a minute. I'll give you a new perspective of the same thing what we have already learned. So look here, I will draw here a timeline. This is year 0, this is year 1, year 2, year 3, year 4, and it keeps on going up to year infinite. So at the last, the symbol is for infinite, sir. Okay. So there are two ways of solving a question. One is you calculate present value of first year, you calculate present value of second year, you calculate present value of third year, you calculate present value of cash flows for fourth year, you calculate present value of cash flows for fifth year, infinite year, and then you make a sum total of all these cash flows, and that sum total will come equal to 41.94. This is similar to making a table for infinite year and then calculating present value of, here, like table for in many long years, calculate amount for each year, calculate present value for each year, make a sum total of all present values to finally arrive at the current fair value, which is 41.94. This is one way of doing it without Gordon's modern formula. But if I'm planning to use Gordon's model formula, then what I will do, first 3 years, I'll consider in the form of table. And here the sum total for first 3 years is 12.79. Okay. And then fourth year onwards, I'll apply the formula. A4 upon R minus G. What this formula will do, listen carefully. This formula will calculate present value of cash flows from 4th year to infinite year at the end of 3rd year. So it will not accumulate all cash flows at 0 year. It will accumulate all cash flows at 3rd year. And that's why we name it as P3. This is the terminal value, fair value at the end of 3rd year. And this is, you can see here, this is 50.37. But I don't want it to calculate at 3rd year. I want its present value at 0 year. So now I'll calculate present value of this amount also. 50 rupees present value. So present value of 50 rupees will be 29.15. And then I'll make sum total of these two figures to arrive at 41.94. So that's the usual way of what we have done. Right, sir? Just have a look at it. You know, there are infinite people who want to get together at your house. Your house is at year 0. There is a party at your house. At year 0, there is a party. You have invited so many people. For Mr. 1, you have sent a car. और वो कार इंडिविजुअली मिस्टर 1 को आपके घर पे लेके आए. मिस्टर 2 के लिए अलग कार भेजी आपने, वो इंडिविजुअली आपके घर लेके आए. मिस्टर 3 के लिए अलग कार भेजी, वो उनको अलग से लेके आए. बड़ा सारी कार है नहीं आपके पास, थक जाओगे आप. तो आपने एक बस बनानी 3 पर खड़ी है एक बस. सो 4 से लेके इन्फिनिट तक के लोगों को आपने बोला एक सिंगल शॉट में आप सब इस बस स्टैंड पर आ जाओ. ये बस स्टैंड है P3. यहाँ सारे लोग आकर के बस में बैठ गए जो 4 से इन्फिनिट तक रहते थे, और वो बस इनको आपके घर पे ड्रॉप करती है. And then this is 29.15. This was what, 12.79. The sum total is 41.94. So this travel by car and this is a travel by bus. Common bus for all. All right, sir. I hope you got this concept. Now let's go ahead. Thank you, Jatin ji. Now we are moving for the next concept. How to calculate the discounting rate. If I know cash flow and rate, I can figure out value. But how do I calculate discounting rate? So let me tell you two things. Either you calculate value of equity, or you may want to calculate value of firm. Either you would like to calculate value of equity or you would like to calculate value of firm. If you want to calculate value of equity, then free cash flow to equity. What is free cash flow to equity? We'll learn later. Should be discounted with. When I say discounted with, means calculate present value with cost of equity. The symbol may be KE. So if you discount free cash flow to equity with cost of equity, you get value of equity. But if you want to calculate value of the whole firm, including preference share, debenture, etc., then free cash flow to firm should be discounted with weighted average cost of capital, popularly known as WACC. WACC, weighted average cost of capital. So now we need to learn what is cost of equity, that is a discounting rate, and what is weighted average cost of capital. Right, sir? We'll learn both. I'll start it from here. Just give me one moment. Okay, calculation of weighted average cost of capital. So first let's learn how to calculate cost of debt. So cost of debt is equal to yield to maturity multiplied by 1 minus tax rate. Oh, so now this new term, yield to maturity. Question is, what is yield to maturity? You know, later we will explore it, but as of now, you can think of it like a very simple concept. It is nothing but, I'm sorry, my chair is not moving. Yield to maturity is nothing but if a bond is issued at par and it will be redeemed at par, then yield to maturity is nothing but the interest rate offered by the company, the coupon rate offered by the company. If a company issues 12% debentures at par and redeemable at par, then I'll say 12% is YTM. What exactly precisely is YTM, that I will explore in fixed income chapter. So YTM, roughly you can say interest rate multiplied by 1 minus tax rate is the cost of debt. So suppose I have issued 10% debentures and tax rate is say 30%. So 30% is tax rate, right? So 1 minus 0.3 will give me 0.7. So 10% multiplied by 0.7 will give me 0.7%. You know, why do I multiply it by 1 minus tax rate? Because when I pay 10 rupees of interest on one debenture, it will be debited to profit and loss account. It will reduce my taxable profit. And 10 rupees multiplied by 30% tax rate, I will save 3 rupees of tax. So while I pay 10 rupees of interest, I get 3 rupees of tax benefit. So that way, I am paying just 7 rupees of interest. So that's why my cost of debt is my interest rate multiplied by 1 minus tax rate. We are trying to calculate the discounting rate. How do I calculate cost of preference share? It is nothing but YTM. So if my company has issued 12% preference shares, so YTM is also 12% and cost of preference share is also 12%. But now, you know, in case of debenture, you offer fixed interest. In case of preference shares, you offer fixed dividend. So it is easy to calculate cost of debenture and cost of preference shares. But what about the cost of equity shares? Cost of equity share is difficult to calculate because there is no fixed dividend which is offered to equity shareholders. So I'll calculate cost of equity share with CAPM, CAPM, Capital Asset Pricing Model. This model was given by Mr. William Sharpe. And for this model and his several other contributions, he got a Nobel Prize also. And it's quite a popular model in real life also. I'm not saying it will solve 100% of the situations, but yes, this model is very helpful. So cost of equity is equal to RF, which is risk-free rate of return, plus RM minus RF, market return minus risk-free rate of return, multiplied by beta. Now, what is this? Let me ask you one question and everybody must answer it, sir. How many of we are there? 11 participants are there. So I need all 11 answers. Okay, I am in need of money because I have started a new venture. It's very exciting venture. And I need money for 5 years. So I request all of you to give me a loan of 10 lakh rupees each. That's the ticket size. 10 lakh rupees per person. Loan to me, Tarun Mahajan, chartered accountant, situated in Indore, for 5 years. And I'll give you interest, I promise. At the end of 5th year lump sum, I'll give you all interest and full principal. and the interest will be 3%. Yes, 3% per annum. Say yes or no, sir. Type your answer. Four answers out of 11 only. Those who don't say no, I'll assume that they are saying yes, and then they will have to give me money. Yes, that's perfect. So you will definitely not give me loan at the rate of 3% per annum. Okay, suppose Mukesh Ambani ji is asking you personally, not as Reliance Industries Limited. Mukesh Ambani ji, richest Indian, fifth or sixth richest person on planet Earth. He is asking, give me 10 lakh rupees of loan, 10 crore rupees of loan, 100 crore rupees of loan at the rate of 3% per annum. Say yes or no, sir. Even a no to Mukesh Ambani ji also. You know why? Because the government of India, big no to Ambani. Even government of India is offering approximately giving 5.5 to 6% per annum. 5.6%. So if government of India bond is considered to be risk-free. They are not going to make a default for Indian rupee borrowings. You know why? Even if they are out of money, they will print further notes and circulate it. They'll repay your loan. They have the power to do it, mind it. Or they will charge more taxes from people. And they'll recover more taxes and repay the rupee loan. They will never make a default in terms of Indian rupees loan. So their loan is considered to be risk-free. If government of India is offering 6% per annum return, then you will never make any investment in India which gives you less than 6% per annum. Yes, Shubhamji. Government can freely print currency. Once upon a time, there was gold standard that if you're printing 100 crore rupees of note, you need to put 100 crore rupees of gold in safety vaults. But gone are those days, many, many years back. Now they can freely print currency. And you know, RBI has already lost its autonomy for past several years. So they can do anything now. So your minimum expectation from any investment is risk-free rate of return. You will never invest your money at a rate of return which is less than the risk-free rate of return of the country where you are investing your money. So that's why if somebody is asking you what is your expectation, you will say at least risk-free rate of return. So now my next question is, so government bond is giving you 6%. Tarun Mahajan will also give you 6%. Say yes or no, sir. Will you give me loan at the rate of 6% per annum? Oh my God, Jatinji, thanks a lot. Yes, government promises to pay only 5 lakh. Earlier it was 1 lakh rupees, sir. But now the guarantee has gone up to 5 lakh rupees. Maybe. Wow. You guys are giving me so much honor. You should have said straight no. Oh my God. Jatinji, you have been there in my class? Oh, I couldn't recall from your face. Sorry. Okay, fantastic. So now, Okay, you were in which batch? At Silver Mall. Whoa, years back, before 2004, it means 2003-4. Right. So rest of the people must be wondering that what they are talking about. So sir, actually, I have been teaching to CA students since year 1999. Last 21 years, I have been teaching to CA students. And Jatinji has been a part of this class. When did I qualify? Okay, you're from Indore only. Yeah, I qualified in 99 only, and before my result, I started teaching. Thank you, everybody. So I've been teaching for last 21 years. This was our first building at Silver Mall. Great. Okay. So come back to our business. You should have said, no, Mr. Mahajan, we cannot give you loan at risk-free rate of interest, because you are just an individual with limited resources. So I will not give you loan. But in that case, definitely you will ask for risk premium. So what do you deserve is risk-free rate of return, plus what do you need is risk premium. Now this risk premium is a fantastic story. Here the theory of here the theory of comparative satisfaction comes into role. Comparative satisfaction. Most of the humans don't have absolute satisfaction. They have comparative satisfaction. So if I'm a newly qualified chartered accountant, in campus interview, I got selected for one job and they are giving me 12 lakh rupees of package in Indore only, a class B city where the cost of living is lower. So I must be very happy. Wow, 12 lakhs of package. Fantastic as a fresher. But at the same time, my friend, who was actually 4 years seniors to me, but after appearing for 8 failed attempts, he was at par with me. He somehow cleared the exam. His general knowledge and smartness is also lower than what I have. The same company offered him a job at 24 lakh rupees per annum. So now my happiness should be tripled. 12 lakh for me and 24 lakh for him. Oh ho! No, not actually. My happiness will actually reduce. It will not triple. दोस्त फेल हो जाए तो बुरा लगता है, पर दोस्त टॉप करे तो और ज्यादा बुरा लगता है. So I will ask to the company, you are giving 24 lakh to this Dumbo. If you are giving him 24 lakh, then my salary should be 36 lakh. Company says your salary cannot be increased. I'll say, okay, at least reduce his salary to 6 lakh. Comparative satisfaction. RM is return on market portfolio, Sensex. Say Sensex is giving 15% per annum on an average. RF is risk-free rate of return. Say risk-free rate of return is 10%. So those who invest in Sensex, they are getting 5% extra as compared to government bond. This 5% extra is risk premium. But this is risk premium for investing in Sensex. But beta of my share, where I am investing money, is 2 times. I'll tell you. I'll give you a proper example. Look here. Say the risk-free rate of return is 6%. Suppose Sensex is giving 14% per annum return. And beta of the security where I am investing money is 1.5 times. 6% is clear to you. What is 14%? Average return on Sensex or Nifty for past several years. 14 minus 6, 8% extra they are getting because they are taking risk. So this 8% is named as risk premium on market portfolio. Now what is beta? Beta is index for systematic risk. Beta is index for systematic risk. Wow. What is that? Index is something, different from measurement. Suppose I ask Amardeep sir that, sir, what is your annual income? Now that's a bad question to ask somebody, that too publicly. And Amardeep sir is smart enough and he says, Tarun, double as compared to yours. Now he answered, and still nobody got it that what is his income. Now when he says double, double is not measurement of his income. Double is index of his income with respect to my income. Beta is not measurement of risk. It is the index of risk with respect to risk of Sensex, I mean market portfolio. So if beta is 1.5 times, it means if market fluctuates by plus minus 10%, my share will fluctuate by plus minus 15%. That is measurement of risk. I'm sorry, that is index of my risk as compared to market. So if people who invested money in market, they are getting 8% risk premium, comparative satisfaction. If he is getting 8%, my risk is 1.5 times. So I deserve more. I deserve 12%. And therefore, the risk premium I deserve is 12%. Risk-free rate I deserve is 6%. And therefore, my expectation of return from this company is 18%. Whatever return I expect from the company, that's an income for me. But that's a cost for the company. Whatever return I expect from the company, that's income for me, but that's cost for the company. So I expect 18%. You know, CAPM tells us manners of expectation from a company. Anywhere in this world, not only in cost of equity, anywhere in this world, if you expect too much, you will lose even the opportunity to earn reasonable. If you expect too less, then you will get that only. A client approaches you, sir, do audit of my books of accounts. What will be the fees? Say the reasonable fees should be 25,000. But you quote it to be 75,000, 3 times. Client will say bye-bye. You will lose the opportunity to earn even 25,000. Expect more, get nothing. But if you quote 5,000 rupees to be the fees, client will say done, agreed, start the work now. Expect less, that, and you'll get that. Expect more, you'll get nothing. Expect reasonable, and you'll get the highest. So CAPM is telling us manners of expecting return. But you know, there is an assumption behind CAPM. And that assumption is, as an investor, you bear only market risk. You know, investor takes, if I buy shares of Reliance Industries Limited, number one, I take company risk. Tomorrow, if the project fails, then I'll also be at loss. But suppose their project is flourishing, but whole economy is downfalling, hence my share is also downfalling, that is market risk. Investor takes company risk as well as market risk. CAPM assumes that your company risk is 0. You know why? Because your portfolio is diversified. You are not investing in one company. You are investing in 50 companies, 100 companies. And that too, which belongs to different industries, different business houses, maybe different countries also. So you have invested in so many companies that if one company out of 50 of your investments, if 10 investments are falling due to company specific bad news and 10 investments are rising due to company specific good news, this bad news and good news will many times cancel each other. And remaining 30 investments are behaving normal. 10 are falling, 10 are rising, 30 are stagnant. You will get a stagnant return. You can diversify away, you can reduce your company risk to 0 by making investment in various securities. Capital asset pricing model assumes that you are a fully diversified investor. Therefore, you need to bother about market risk only, and that market risk is measured by beta. That is reaction of my share with respect to change in market. But now practically what happens? One of your clients one day approaches you that, sir, I am a steel manufacturing company and I'm going to acquire another steel manufacturing company. Can you help me to make valuation of that company, target company? You ask him, are you diversified into cement and software and FMCG and electricity and banking and insurance also? He says, no, never. I do just one business. So now your client is bearing not only market risk, but also here he is bearing company risk. If you are making valuation from his point of view, not from the best participant in the market point of view, then you need to add company specific risk premium also. And some people, they name it as alpha. Some people, they name it as alpha. It's not a standard terminology. So I'll say for company specific risk, I need 4% extra risk premium. And practically my discounting rate for valuation assignment should be 22%. This is not specified by CAPM. Probably they will not ask it in examination also, but in real life, you need to take care of it. And this is based on your experience and your gut feeling. There is no proper way to measure company specific risk. The company specific risk will involve many things, like the industry to which company belongs. Tomorrow that industry may mature and start declining, or the management of the company is not as strong as the management of the big companies out there, or the company is smaller in size, so that's why this company is more vulnerable to changes in market. So all these things are factored in the alpha or the company specific risk. I would like to tell you two more things. When I talk about risk-free rate, this is going to be interesting. Sometimes CAPM fails, so you can use the built-up approach, and the built-up approach is adding bits and pieces of various items of your required return to arrive at the final rate of return. Risk-free return comprises, okay, let me ask you one question. Why do you demand interest from Government of India bond? Zero risk deserves zero return. Aren't you greedy? Why do you ask? Risk-free return from Government of India. Okay. Amardeep sir is saying time value of money. 9 more answers I need, sir. 10 more answers I need. Come on, at least say pass. Because it's secure to opportunity cost. Okay. Since it's our hard-earned money, point. Are resources being used by government for further investment? Okay. So, Shailendra sir, you are somewhere near the answer. Since it is our hard-earned money and we earn money, we pay taxes. So if government doesn't charge tax, suppose you got 12A exemption, then you should not charge any interest from government. Okay, but thanks for answering. Why do you earn money? Because you want to consume it. Think about it. Why do you earn money? Because you want to consume it either today or tomorrow. If government not earning on our money, we will not ask from them. Oh, no, sir, that will be wrong. So if you give me loan and I keep it idle, you will not charge interest. No, it's not going to happen. If you give me loan and I earn huge, you will ask me huge. No, this is not happening. So the answer is, why do you earn money? Because you want to consume it. Say you are going to buy a SUV, a good car with 10 lakh rupees of your money, because you want a car now, and that too a big one. And meanwhile, I came and I said I need money for my business for next 5 years, and you give me that money. Now you are not able to consume your own money. You have deferred your consumption. You have deferred your plan to buy the car for next 5 years. You're making a sacrifice of your current consumption. And that's why you need a compensation for deferment of consumption. That's why you ask for a rate of return, say 3% per annum. Then you ask for a rate of return even from Government of India, because when Government of India will return your money, by that time the car might have gone expensive due to inflation. And that's why you charge inflation also from Government of India. So probably that way 3 plus 3, 6% you will be charging from Government of India. Now think carefully. Tell me one thing. If preference of current consumption rises, people say there is no tomorrow. Live like there is no tomorrow. COVID-19 से बड़ा कोई वायरस आ गया, पूरी दुनिया खत्म हो गई, प्रलय आ गया, सब खत्म हो गया, तो पैसा तो मेरा धरा रह जाएगा. Better I enjoy my money today. कल का क्या होगा वो कल देखेंगे. What will happen to risk-free rate of return if current consumption of the people have preference of current consumption over future consumption? What will happen to risk-free rate? If people started thinking कि आज ही पैसा खर्च कर दूं मैं तो, okay, I got one answer. Will it rise? Will it fall? Will it remain same as before? Only two answer.
Sir, please repeat the question.
Question is, लोगों का करंट कंजम्पशन का प्रेफरेंस बढ़ जाए. जो कल कंज्यूम करना था, फॉरेन टूर पे 3 साल बाद जाना था, तो अभी चलो. पार्टी 2 साल बाद देनी थी, तो अभी दे दो. पता नहीं कल हम जिंदा बचे ना बचे. So Shailin sir, your answer is actually correct. Risk-free rate of interest will rise. I want to consume my money today, and you are saving, give it to me today as a loan, and I'll use it in my business, and after 3 years I'll give it back to you, and then you can consume. I'll say, no, I want to consume it now. I'll not give you as a loan. Then you will say, okay, I'll give you higher interest. जब आप मुझे ज़्यादा लालच देंगे, तो फिर मैं अपने consumption को defer करूँगा. If preference for current consumption rises, risk-free return will rise. Hence, cost of equity will also rise. If inflation rises, risk-free return will rise. Hence, cost of equity will also rise. On the other hand, if the people become, this is the Chaturmas time, and they listen to the lecture of some divine person, and some Sadhu Mahatma says, Sab moh maya hai, aparigraha, live on minimum. There is one word, Satya Hinsa. One of the words is aparigraha, live on minimum resources. Do not damage Mother Nature. And you say, okay, I will live on minimum. I'll eat 1 time a day only. Ekashna I will do. And rest of the thing I'll stop consuming. So now you have a lot of money because you don't want to consume it. And money supply will increase in the market. And the rate will come down. So this is the thing, sir. Now, similarly, there are things with respect to risk premium also, and there are things to be discussed with respect to beta also. So that we will discuss after the lunch break, sir. So it's approximately 1:30. We'll be back by 1 hour, approximately 2:30. Whatever doubts you have, you can post it here, and post lunch, I'll solve your doubts, sir.
Till what time we are,
5:30 around?
5:30.
Yeah. But maybe 5:45 also, but 5:30 to 6 maximum.
Yeah, thank you.
All right, sir. See you back after the lunch. I just request you to have some light lunch. And if feasible, take a 10 minutes nap also, so that you come refreshed, more energetic. All right, sir. Thank you. Okay, welcome back to the session. So here we go. So we were studying how to calculate weighted average cost of capital. Cost of debt is simply interest rate multiplied by 1 minus tax rate. Cost of preference shares.
सर
Yeah.
सर नींद से जगा तो दीजिए सबको पहले। आपने गोलीबारी शुरू कर दी है।
कौन सो रहा है सर?
मैं तो थोड़ा जाग रहा हूँ।
आप जाग रहे हैं? नहीं सर, इसीलिए थोड़ा सा पुराना रिवाइज करवा रहा हूँ, सब जाग जाएंगे, डोंट वरी। I'll start asking questions ना अभी।
आप मतलब ऐसा लग रहा है जैसे वापस आए हैं, अपनी पोजीशन भी नहीं ली है और सामने से फायरिंग शुरू हो गई है।
सर ये खतरनाक खेल है, इसमें ऐसा ही होगा।
Arun sir, you still look same. Is 15-16 years back, around 17-18 years back.
अरे वाह, थैंक यू जतिन जी, थैंक्स लॉट। काफी सारी चीजें। चलिए, अब जैसे मुझे अमरदीप सर ने कहा कि थोड़ा नींद से जगाइए, तो मैं एक बार मैं अपना सुबह मेरा इंट्रोडक्शन वाला पार्ट रह गया था।
इंट्रोडक्शन अभी कुछ लोगों का और भी रह गया है, जैसे मुझे लगता है प्रवीण का रह गया है, मैडम एक है उनका रह गया है, या फिर एक दो लोग और भी हो सकते हैं, मुझे पता नहीं है।
अच्छा,
प्रवीण का तो आपने दे दिया था। हेलो प्रवीण को तो आपने अपने इंट्रोडक्शन साथ प्रवीण का इंट्रोडक्शन कर दिया था।
वीडियो ऑन करना कर लो।
तो चलिए सर, मेरे के साथ स्टार्ट करते हैं, और मेरा तो सबके साथ ही बचा है। तो दिस इज, तो I'm तरुण महाजन। So I became chartered accountant, जैसा मैंने आपसे बात हो गई थी। I did CA in 1999।
ऐसे करेंगे तो ये पूरा ही सब
21 years back। फिर साहब हमको CA इंस्टीट्यूट ने बोला कि आप एक कोर्स कर लीजिए, डिप्लोमा इन इंफॉर्मेशन सिस्टम्स ऑडिट, तो आपको अच्छे बैंक ऑडिट्स मिलेंगे उसके बाद में। सो आई डिड इट। बैंक ऑडिट तो खैर कुछ मिला नहीं इससे, और ये सब भूल भी गया मैं डीसा। इससे एक ही चीज अच्छी सीखी थी, हाउ टू क्रिएट अ गुड पासवर्ड विच इज इजी टू रिमेम्बर एंड वेरी डिफिकल्ट टू क्रैक। रॉन वेबर की बुक पढ़ी थी, वो उससे एक ही चीज आज तक समझ में आई। Then sir, I did
यही तो बोल रहा है ना। बस देख रहे हैं इसका डिग्री क्या, क्वालिफिकेशन क्या।
मुझे किसी का म्यूट करना पड़ेगा।
बस ये।
Then I did CFA also. From CFA USA in year 2008. उसमें CFA सर उतना फैशन में बोलना चाहिए कि नहीं था। So I was the first one from Central India, and there were 379 CFA charter holders in India at that point of time. Then उसके बाद में सर ये देख के आपको बहुत खुशी होगी, क्योंकि आपके साथ भी ऐसा ही कुछ होने वाला है अब। I cleared this IBBI valuation examination in January 2019 in first attempt, and that too with 80% marks. तो बस सर वैसे ही कुछ आप सब लोगों से भी एक्सपेक्टेड है।
This is great, sir.
थैंक यू सर, थैंक यू। तो मैं चाहता हूं कि आप सब लोग भी फर्स्ट अटेम्प्ट में क्लियर हो। मार्क्स इंपॉर्टेंट नहीं है, वो 60% के ऊपर एक नंबर भी ज्यादा है, दैट्स नॉट इम्पॉर्टेंट, बट आप सब फर्स्ट अटेम्प्ट में जरूर क्लियर हो। एंड देन जैसा हमने डिस्कस किया था, आई हैव बीन टीचिंग सीए स्टूडेंट्स फॉर लास्ट 21 इयर्स। देयर वाज अ पॉइंट ऑफ टाइम जब, अभी तो सब सीए फाइनल पेन ड्राइव मोड पे शिफ्ट हो गया, अदरवाइज सीए फाइनल की एक सिंगल बैच में 950 स्टूडेंट्स एक सिंगल क्लासरूम के अंदर वी यूज्ड टू टीच। दैट वाज अ बिग रूम। And then I have guided more than 1400 professionals. अब ये नंबर शायद 1600 या 1500 हो गया होगा। In 50 hours valuation course training in last 1.5 years. और कुछ जुनून बीच बीच में जागते रहते हैं सर। तो हमारे जो विजय जी हैं, विजय जी भी एक मैराथनर हैं और उन्होंने भी काफ़ी सारी मैराथन्स की है। विजय गुप्ता सर, promoter of this RVO. So I did Mumbai Marathon 42 kilometers in year 2013-14. फिर हम लोगों ने साइकिलिंग स्टार्ट की सर, और साइकिलिंग में कंसेप्ट होता है रेंडोनियरिंग, जिसमें राइड्स होती है 200, 300, 400, 600 किलोमीटर्स की लिमिटेड टाइम के अंदर। सो आई डिड अप टू 600 वाज इन 37 आवर्स। फिर कभी स्विमिंग करी थी अच्छी खासी, अभी कुछ नहीं, अभी सिर्फ योगा करते हैं। Then I have written a book also titled as My Marathon. So it is available on Amazon. और मेरे कॉन्टैक्ट डिटेल्स तो आपको वहां पर मिल जाएंगे, जो मैंने आपको नोट शेयर किए हैं उसमें आपको मेरा मोबाइल नंबर और ईमेल आईडी दोनों मिलेगा। और
तरुण सर
जी,
ये जो पूरा कोर्स है वो पूरा का पूरा कोर्स आप हमें करें मतलब करवाएंगे या फिर और भी फैकल्टीज?
नहीं, और फैकल्टीज हैं। देखिए, मैं वैसे भी जब लेता भी हूँ तो सिर्फ फाइनेंस पार्ट लेता हूँ, तो मैंने मैक्सिमम 31 आवर्स तक का लिया हुआ है। बियॉन्ड जो रिमेनिंग 19 आवर्स आता है वो पूरा थ्योरी आता है, मतलब कि लॉ आता है। सो आई डोंट हैंडल लॉ, सो आई विल बी टेकिंग अराउंड 21 आवर्स। Then Sumit Dadda sir will be there. He is also a great faculty. Also, what I will remove, he is a great faculty. So he will be taking that theory part and he is fantastic. और फिर एक दो फैकल्टीज अक्सर ही और भी ऐड जुड़ती हैं यहाँ पर सब साथ में, कुछ और पार्ट को कवर करने के लिए।
ओके,
राइट सर।
एंड द टोटल कोर्स इज फॉर 50 आवर्स।
50 आवर्स। अच्छा, इसमें एक और ये बात भी होती है कि 50 आवर्स का कोर्स है और 100 मार्क्स का पेपर है। तो समटाइम्स दिमाग में ये आता है ना कि कौन सा पोर्शन कितने मार्क्स का है। तो टेंटेटिवली रफली आप ऐसा कर लें कि जितने आवर्स हम किसी कंसेप्ट पे डिवोट करते हैं, एवरेज मल्टीप्लाइड बाय 2, दैट विल गिव यू मार्क्स। तो अगर आपने मान लीजिए ऑप्शन वैल्यूएशन 3 आवर्स पढ़ा तो अप्रोक्सीमेटली 6 मार्क्स। ऐसा हार्ड एंड फास्ट नहीं है, बट रफली ऐसा होता है।
और ईच डे इज फॉर हाउ मेनी आवर्स?
7 hours. So 7 hours, 7 days, roughly 49 hours, 50 hours.
Okay, so 7 days course.
7 days course. बिल्कुल सही।
Thank you.
सर, आप लोग सब कौन सी सिटीज में हैं? अगर ये वीडियो के सीक्वेंस में से बात चालू करें तो अंजू मैडम का वीडियो सबसे पहले आता है। मैडम, आप कौन सी सिटी में हैं? अब मैं अनम्यूट शायद मैं सबको कर पाऊंगा, या आप खुद को अनम्यूट कर लीजिए पहले, हम सुन नहीं पा रहे हैं आपको।
अंजू मैम का वीडियो में प्रॉब्लम है, ऑडियो में।
अच्छा, ऑडियो में प्रॉब्लम है क्या? ओके, एक बार यहाँ से मैं देखूं शायद सब। हाँ, अच्छा, ओके। अच्छा, यू आर फ्रॉम दिल्ली? नहीं अंजू मैम, ओके। अतुल जी इज फ्रॉम दिल्ली। सर, ऑडियो ऑन कर सकते हैं आप लोग? जतिन जी, यू आर स्टिल इन इंदौर?
Yes, sir. Actually, I was in Mumbai from 2005 to 2013. Then I moved back to Indore. 2014 onwards I'm here.
बट हम लोग कभी इसमें अपने CPRs वाली ट्रेनिंग में कभी क्रॉस नहीं हुए शायद।
हाँ सर, नहीं एक्चुअली मैं थोड़ा कमी, मैं तो अभी तक मुंबई रहता हूँ, अभी भी इनफैक्ट प्रोजेक्ट्स वगैरह मुंबई के लेता हूँ।
ओके, ग्रेट। संजीव शर्मा सर, आप कहाँ से हैं सर?
हेलो।
यस सर।
आई एम फ्रॉम पटियाला सर, पंजाब।
अरे क्या बात है सर, ग्रेट।
तरुण सर
जी,
मैं और सुमित दत्ता हम दोनों पीडब्ल्यू में साथ में काम करते हैं, सेम बैच।
अच्छा, क्या बात है, अरे वाह, ग्रेट।
वी वर टू वर्क टुगेदर।
तो सुमित डड्डा सर को तो मैं ये फील्ड वो करता हूँ एक्चुअली, व्हेन आई वाज टेकिंग ट्रेनिंग इन इंदौर फॉर दिस 50 आवर्स। तब सुमित डड्डा सर वाज माय फैकल्टी।
ओके।
और उन्होंने इनकरेज करा कि यार आप को फाइनेंस वाला सेशन लेना चाहिए, उन्हीं की वजह से मैं यहाँ हूँ आज। क्या बात है, ग्रेट ग्रेट। पटियाला से सर आप प्रैक्टिस कर रहे हैं सर, संजीव सर?
सर मैं अभी 30th of June को आई रिटायर्ड फ्रॉम पंजाब पीडब्ल्यू V&R.
Okay, PSU है सर?
I was working there as a no, it is government department, public works department, Punjab.
अच्छा, PWD. Okay.
This is building and roads wing. Hello.
Great. हाँ सर, सुन पा रहे हैं हम आपको अच्छे से।
So I just retired on the 30th of June.
अच्छा, क्या बात है, ग्रेट सर। आप
So that's why I'm feeling a little bit difficult. It is some bit difficult for me to understand all these terms being civil engineer. So ये financial जो है details, anyhow it will be worked out, no problem.
ओके, ग्रेट सर। आपने MBA भी किया है क्या सर, मतलब?
No, I'm not MBA.
ओके।
हाँ.
और संजय सर, आप कहाँ से हैं सर?
या मैं मुंबई से हूँ और आई एम इन एम्प्लॉयमेंट, सो
ओके।
आई वर्क फॉर अ US MNC which is in medical diagnostics.
Okay.
So like is a part of Danaher Group. Danaher, you might be knowing it. It's a private equity group in the technology sector, medical technology sector. So they have around some 50 to 60 companies of valuable brands. Like one is Beckman Coulter. You might have heard about Leica. Leica is like in the microscopes, and there is another company called SFA, which is in the molecular diagnostics, then blood gas analyzers, cancer research, cancer markers. So basically, I'm namesake company secretary, but I'm mostly in the business development.
Okay.
So, I have developed business in Southeast Asian countries like in Bangladesh, Sri Lanka, Nepal, Bhutan. So my major role is business development, channel partner management, and the compliances from US FCPA, UK bribery, and then all other laws which are US laws applicable to any multinational company. So I manage around 300 channel partners. हाँ, लास्ट ईयर तो ऑन एन एवरेज 20 से 22 दिन एक मंथ में ट्रैवल था। पूरा 2019 तो एक्सटेंसिवली ट्रैवल किया बिकॉज आई वाज वर्किंग ऑन वन प्रोजेक्ट। सो आई ट्रैवल्ड विद इन इंडिया, आउटसाइड इंडिया, to Europe and other countries also. So there was a sort of audit, I would say, because we were doing some kind of a management exercise to revamp our distribution system. Because like we wanted to make channel partners to make more value addition to our businesses. So that's why like I went around. And normal I travel 10 to 12 working days in a month.
ग्रेट। आपको थोड़ा ब्रेक अच्छा लग रहा होगा एक बार के लिए, तो ये ट्रेवल रुका है तो
पिछले 10 साल से तो ट्रैवल ही कर रहे हैं। लास्ट ईयर तो बिल्कुल ही नहीं। सैटरडे इवनिंग आता था, संडे आफ्टरनून या अर्ली मॉर्निंग फ्लाइट लेके सब निकल गए। तो माय डॉटर इज 10 years old, so she used to say भाई कब घर आ रहे हो करके। तो मैंने कहा जब प्रोजेक्ट खत्म होने को टाइम है। एंड द लास्ट ट्रैवल व्हिच आई डिड वाज ऑन 24th of December. Dehradun was the last travel, and after that like travel शुरू हो ही गया था। I traveled to Chennai on 7th of January, and after that no travel. So like I'm happy right now.
That's great, sir.
But I don't know about 2021 I'm going to be placed.
Right, sir. Shailendra sir, आप कहाँ से sir?
Sir, I'm from Delhi itself. So
Okay.
I born and brought up in Delhi. Like Sanjay sir, I also associated with a company which is based from Thane, Mumbai. So they are in, it's a UK-based sister concern, and they are into facility management. That is called OCS Group India. So they having presence pan India. They are doing uh, facility services as well as maintenance and technical support for the airports, multi-story buildings, and we must be heard about CBRE and JLL. So on the similar line, my company is doing business. So like I also not working as a full-time company secretary. My major role into business controllership, such as recovery of funds and everything, credit control, as well as I look after all the insolvency and bankruptcy matters. And at the same time, commercial contract and rest of the RFQ applied for the Indian Oil, Indian Airports Authority of India, and various other government organizations, where there is a technical and other kind of RFQ has been floated by the government of India. And before that, I was working for a company which is Italian-based company. It was a healthcare company, Clear Medi Healthcare, and we having a joint venture with the Italian company that is called Medipass and COS SPA. So just for the understanding of all the members, so it was a very unique kind of a business of Medipass and COS SPA. Like we in India see that the hospitals are, they are providing full kind of services such as, surgery and patient care and everything. What happened in Europe, hospital are mainly focused on, treatment and diagnosis thing. And once the patient goes out from the, ICU and operation theater, there is a separate kind of buildings are made by the private players who take care for the day-to-day routine that is called OPD or IPD services. So this is a kind of way that the cost SPA having more than 10,000 bedded in Europe.
Wow.
So Shailendra, where are you based, in Mumbai or?
Sir, I based from Delhi itself.
Okay.
Yes, sir. I got an offer, but there was a kind of arrangement between company and me. So somewhere I able to settle. I sit in Gurgaon office, and in a similar manner, in my past organization, there is a company called Subram Hospital Private Limited. They also having a tie-up with the Italian company.
Right.
So that is a Servizi Italia. So Servizi Italia is into what we call say laundry services for the healthcare industry only. So Servizi, yeah. So it is a first kind of a business system in coming into India, where we do cleaning of clothes for the hospital industry completely automated channel. So there is no such kind of a human intervention for washing, then cleaning, then ironing and everything. Once the dirty clothes come into our plant, we keep into certain kind of segregation in boxes, then it goes into washing and everything. And the final product, there are certain kind of a very minor kind of like once the cloth come from the washing area, then it, only some kind of very minimal kind of things happening by the manpower. Rest of the things are automated. And it is something kind that like Jatin's Tarun sir wearing this coat. If I hang on the what we call say hanger, it will go into machine, it will automatically automated iron, fold it, and then comes out.
Wow.
So in coming, I will share with that a link of that video. It was very interesting, sir. So
do share it, sir. Do share it in the chat box.
Yeah, and the capacity of that plant is that every day they can wash and clean 60 tons.
Great, great. चलिए सर, बड़ा अच्छा लगा. अब हम थोड़े से इंट्रोडक्शंस कल के लंच ब्रेक के लिए रखते हैं. Remaining we'll have tomorrow after the lunch session, क्योंकि अभी 3 दिन तो हम साथ में ही हैं, आज कल और परसों. Right, sir? Okay, so it was nice interacting you guys. Now getting back to our business, हम लोगों ने पढ़ा that the risk-free rate of interest comprises compensation for deferment of consumption as well as inflation. This is RF. What about RM minus RF into beta plus alpha? There is risk premium. So risk premium, I'll say, comprises number one, degree of risk aversion of investor, degree of risk aversion of investor, and then measurement of risk. When I say aversion, I mean hate for risk. And this is measured by beta. And then industry and company risk premium. So guys, I need two things as rate of return. Number one, risk-free rate of return, which comprises these two elements. Number two, risk premium. So first thing is degree of risk aversion or my hate for the risk. If my hate for the risk increases, you know what happens in that case? If my hate for risk increases, then I will start charging more risk premium for taking the single unit of risk. Say currently for taking risk equal to 1 beta, I'm asking risk premium of 8%. But if my fear for risk, if my hate for risk increases, then for taking same risk, I'll be demanding more premium. So people keep on asking, what is the impact of COVID-19 on valuation? So one of the major impact is, more fear for the market. So if there is more hate for the risk, more fear for the risk, people will start charging more risk premium for taking same unit of risk. Then the risk itself, higher the risk you take, higher the risk premium you demand, and vice versa. Okay, thank you for sharing this link. I'll just do one thing. I'll keep it saved here so that later, it is not lost in the trail. What is this? Just a minute. I will save this link. Okay. Now, industry and company risk premium, that is indicated by alpha. We already discussed that. Right, sir? Just give me a moment, please. Okay. So these all things together make expectation of investor. And this is how you calculate cost of equity. And once you calculate cost of debt, cost of equity, cost of preference shares, thereafter you can calculate weighted average cost of capital, which is better named as KO, overall cost of capital, or WACC. So this is nothing but the formula for weighted average. You take cost of debt, say 7%, and multiply it by amount of debt. Then you take cost of preference shares and multiply it by amount of preference shares. Then you take cost of equity shares and multiply it by amount of equity shares, whole divided by amount of debt plus amount of preference plus amount of equity. Now keep in mind one thing over here, that when you assign this D, P, and E amount, here market value weights are better than book value weights. Market value weights are better than book value weights. So if market value weights are available, then for calculation of weighted average, one should take market value weight. So here we go with one question. Calculate WACC with the help of following information. 12% debt, tax rate is 30%. Rate of return on 10-year government of India bond is 9%. So type in the chat box, sir, what is this? What is the symbol for this under CAPM equation? Okay. We have 2 answers, waiting for more answers. So Amardeep ji, Vishwanath ji, Shubham ji, and Jatin ji and Sanjay ji. Atul ji and Rajesh ji have also answered. Yes, this is the risk-free rate of return. That's the perfect answer. Rate of return on Nifty. What is this, sir? What is the symbol for this? Okay. 2, 3, 4. Yes, this is return on well-diversified market portfolio. That is RM. Okay, then how do you name RM minus RF? This is RM, market on return, rate of return on market portfolio. What is the name of RM minus RF? That's right. That is the risk premium, or better I say, that is the risk premium on market portfolio. RM minus RF is the risk premium on market portfolio. Okay. Risk premium on market portfolio, and RM minus RF into beta, that is the risk premium on investors portfolio. RM is market return, RM minus RF is market risk premium, RM minus RF into beta is risk premium on market portfolio. Okay. Then sensitivity of stock with respect to Nifty. Yes, exactly, Shubham ji. This is beta. Debt to equity ratio is 2:3. So that will be used to calculate weighted average cost of capital. Now I request you to calculate cost of debt, and then to calculate cost of equity, and then to calculate weighted average cost of capital. This will help you to calculate KD. This will help you to calculate KE. And the last point will help you to calculate WACC. Okay, fine. And this is a simple calculation. Request everybody to do it. So keep on posting step answers also. Like when you calculate KD, post KD. When you calculate KE, post KE. Then WACC. Formulas are there in PDF file also, sir. Last 2 pages of PDF file contains all formulas.
12% debt tax rate. Atul ji, this 12% debt tax rate is equal to 30%.
12 into 0.3, yes. That will be 8.4. 12 into 0.7. 1 minus tax rate, sir.
Where from 0.7 is coming?
1 minus tax rate. Tax rate is 30%. So this is 1 minus 0.3, and that's why 0.7. So it's like if you pay 100, your cost is just 70% because 30% you will be getting tax benefit. Okay, some people got VAC also. And you know, VAC is simple. KP, no sir. KP is not there in this question. There are no preference shares. All right, sir. 2:3 weight is to be given. 2 weight here, 3 weight here, total of the weight 5. You know, answer must be between 8.4 and 18 because a weighted average of two numbers must be between those two numbers only. So unluckily, if you get an answer less than 8% or more than 18%, then you need to cross check it because VAC cannot be beyond the boundaries. Boundaries are the minimum and maximum cost. All right, sir. Now, let's discuss further about beta. So tell me, what if, say, I'll remove from here. What will happen to cost of equity if beta is 0?
Cost of equity will be risk-free return.
Okay, that's one answer.
Risk-free return. Yes.
Yes, exactly. You know, if I put here beta is equal to 0, 0 multiplied by bracket will be 0. So I'll be left with RF only. That is mathematically. Logically speaking, if beta is 0, what does it mean? Your security does not have a fluctuation with respect to change in market. It remains fixed. So there is no risk. Though no fluctuation means no risk. And that's why you deserve risk-free rate of return. Then what if beta is equal to 1, sir?
Cost of equity would be higher than risk return in the market risk.
Yes, it will be higher than risk-free return. That's true. And last line was?
Risk premium. That,
okay.
It will be return on market only.
Okay.
Risk-free will be like 0.
What do other people say, sir? Everyone's participation is appreciated, sir. Okay, 1 pass. I'm saying, what if beta is equal to 1? What will happen to cost of equity? If beta is like 1. Yes, if beta is equal to 1, yes, KE will be equal to RM because RF and RF will be cancelled. So you'll be left with RM. That's mathematically, logically also, if beta is equal to 1, then your share is as volatile as the market. Volatility of your share is equal to volatility of the market. So you deserve return also equal to market. And in that case, your cost of equity, that is your expectation from equity, will be equal to market return. And if beta is more than 1, then you deserve a return more than the market return. If beta is less than 1, say 0.5, in that case, you deserve a return less than the market rate of return. Can beta be negative? You have to say yes, no, or pass. And I need all 11 answers. From all 11 participants, I need answer. I got 2 answers, 3, 4, 5, 6, 7, 8. Where are 3 other people? Praveen ji?
Yes. Yes, I answered, sir. I answered.
I think you answered? Okay, okay. So, now let me tell you the correct answer. This is a 1 mark MCQ. Can beta be negative? Yes, no, maybe, none of the above. So, yes, beta may be negative, but that's a rare event in real life. In short run, beta may be negative, but in long run, beta will always be positive. Like after March 2020, due to this COVID-19 situation, when entire market was falling, some of the pharmaceutical companies' stock were rising. So market falling, my share rising, that's a kind of negative beta. In short run, beta can be negative, but in long run, beta will always be positive. In long run, if beta is negative, what does it mean? Your direction is opposite to the direction of market. In long run, market keeps on rising. Whether it is Sensex or Nifty, after all shocks, after all downfalls, it ultimately rises. So market is ultimately rising. Beta is negative, so your share will be ultimately falling. And there is a limit to fall, which is 0. Therefore, in long run, beta cannot be negative. But yes, in short run, beta can be negative. It's possible. Now, how do I calculate beta? that is one more question. So I'll give you an idea about how do I calculate beta. Like this is calculation of beta. Suppose I'm taking data for last 5 years. In real life, I'll take data for at least 20 years, but here I'm taking data for last 5 years. And on x-axis, so I calculate return for Sensex for 5 years. I calculate return for ABC Limited for the same period of 5 years, which is listed on Bombay Stock Exchange. Maybe it is listed on National Stock Exchange, that hardly matters, but it is listed. So suppose Sensex provided a return of 10% and 15% and 2%, minus 3%, 12% in last 5 years. In the same time period, ABC Limited provided a return of 12%, 20%, minus 1%, minus 8%, plus 20%. So this is year by year return on Sensex, and then year by year return on ABC Limited share. If I want to calculate a beta between the two, then thank God that there's a ready-made function in Excel, and that function is named as slope, S-L-O-P-E. Yes, you heard it right. It's slope. When I want to calculate slope, it asks me Y value and X value. So Y value means dependent value. X value means independent value. When you make a diagram, x-axis, y-axis. The horizontal one is x-axis, the vertical one is y-axis. X-axis you put independent variable, y-axis you put dependent variable. So on x-axis you put your performance, on y-axis you put your performance bonus. Performance bonus is dependent on performance. So on y-axis I take ABC Limited because it is dependent on market. I selected this data, then I put a comma. Then on x-axis, I take Sensex. A close bracket. And then I simply press enter. And beta is 1.67. So look, this is how you calculate beta in real life. Now, beta, if I give you more technical details about beta, how does it look like? I'll draw it for you. So first I'll draw this x-axis. Here I'm taking return on market portfolio, that is RM. And then I draw this y-axis. Here I'm taking return on investors portfolio, that is ABC Limited. So better I should write ABC. So in first year, market provided a return of 10%. So this is like 5. This is like 5%, 10%. Okay. And ABC provided return of 12%. So 5, 10, 12. So this is like 12%. So I draw a point. And this is just one single point. With one pair of data, I get 1 point. So if I take 20 or 40 years, I'll have many points like this. Okay. Now, if someone tell me join all points with a single straight line, that's not feasible. But if you tell me draw a line of best fit, so definitely I can draw a line of best fit. So number of points below the line and number of points above the line are equal in distance with the line. Line of best fit. Now, if I measure angle of this line, angle, this is the angle. I hope you're seeing my video also. So if I calculate angle of this line, how do I calculate it? So I draw a line parallel to x-axis. Then from the geometric box or the composite box, I take the protector and put it here, the D-shaped protector, and measure this angle, which is represented by theta. Suppose this angle is 45 degree. So next thing I do is I calculate tan theta, and tan theta is actually beta. So sin theta, cos theta, tan theta. So tan 45 degree is actually 1. So in this case, beta is 1. If angle reduces 10 40 degree, 10 30 degree, 20 degree, 10 degree, 10 0 degree, then beta will also reduce. This is, look, this is 0 beta. This is 1 beta. So 0 to 1 beta is rising. And if angle further reduces, beta will be 2, 5, 10, 20, 30. Like that. So if somebody asks you what is beta, you can say it is nothing but tan theta. Just to give you an idea that what is beta and how do I calculate it. Now the more important thing here is how do I calculate year by year return? So return for a year is equal to, D1 plus P1 divided by P0 whole minus 1. D1 is dividend at the end of first year. P1 is price at the end of first year. P0 is price at the beginning of first year. So for example, a share has given us dividend of 8 rupees, and at the end of the year, or let's say dividend of 4 rupees it has given us. At the end of the year, share price is 220 rupees. At the beginning of the year, share price was 200 rupees. So I invested 200 rupees and now my value is 224 rupees. Deduct 1, so 0.12. Or I can say in percentage format, it is 12%. This is how I calculate return for any 1 year. So return for any 1 year depends upon price at the beginning of that year and price at the end of that year. Okay. Price at the beginning of that year and price at the end of that year. But what if, just a second. What if a company's share is not listed? Then you won't have price at the beginning of the year. You won't have price at the end of the year. So you cannot calculate return for a particular year. And if you cannot calculate return, then you cannot calculate beta. Moral of the story, beta can be calculated only for a listed, frequently traded company. If company is unlisted, you cannot calculate beta this way. Then what to do in that situation? How to calculate beta of unlisted company? In real life, you'll get valuation assignments mostly for unlisted companies. So in that case, you will have to use this one, the pure play technique, which is also named as bottom up beta approach. that is adjusting the beta for leverage and tax effect. Adjusting the beta for leverage and tax effect. What is pure play technique? See, the pure play technique or bottom up beta approach is like this. My company is unlisted. I found a similar company which is into same type of business and roughly same size of the company, but that company is listed. My company is not listed. I'll calculate beta for the comparable, similar listed company. And whatever is their beta, so I'm into business of manufacturing and selling cement, but unlisted. I found a comparable listed cement company. Their beta is 0.875. So my beta should also be 0.875. But you know, I cannot simply copy paste their beta because as they say कि नकल करने के लिए भी अकल चाहिए. Though our business risk is same, I am a cement company. That is also a cement company. Though our business risk is same, but our financial risk may be different. That company may have a debt equity ratio of 1:1. I may have a debt equity ratio of 2:1 or vice versa. So I need to adjust their beta for the loan effect, which is also named as leverage effect. How do I adjust the beta for leverage effect? So there was one gentleman named as Mr. Robert S. Hamada, and he gave us a formula which is better known as Hamada formula. And look, this is the formula. Beta L is equal to beta U into 1 plus debt equity ratio multiplied by 1 minus tax rate. Look, what is levered company? Can somebody tell me? What do I mean when I say that a company is levered? Levered.
It has taken loan.
Okay, 2 answers. 3.
Borrowed money to finance asset.
Sorry, sir.
Borrowed money to finance assets of the company.
Okay. Okay. Right. Yes, that's right. If a company has debt, whether it is long term or short term, if a company has debt in its capital structure, then the company is named as levered. But if a company is purely financed by equity, no long term debt, no short term debt, then the company may be named as unlevered. So beta L is the equity beta of levered company, and beta U is the equity beta of unlevered company. So beta L and beta U, both the betas are equity betas, but one is levered beta and the other one is unlevered beta. T is equal to rate of income tax. Okay. Now, how will I use this formula? Let me tell you. So I found a comparable company which has a debt equity ratio of 3:1. My debt equity ratio is 1:1. So first of all, that company is highly levered. My company has low leverage. So I'll put that company's beta over here at the place of beta L. And as a balancing figure, I'll calculate beta U. That is from 3:1 debt equity ratio. I'll calculate beta for a zero debt company. Once I get unlevered beta, then I will lever it again. So what do I do for that? To lever it again, I will calculate beta L again, but this time for a debt equity ratio of 1:1. So from 3:1, I bring it down to 0 level. From 0, I bring it up to 1:1 level, which is my level of debt. And that will be the beta, which is useful for my company. Yes, sure, Shailen sir. When I say levered company, means a company which has long-term debt or short-term debt in the liability side of its balance sheet. If there is debt in capital structure, company is levered. So let me tell you one more thing over here, that when I calculate weighted average cost of capital, I not only take cost of long-term debt, but also I should take cost of short-term debt. So company has issued debenture, that is 1 KD. Company has taken term loan from the bank, that is second KD. Company has taken working capital loan from the bank, that is third KD. KD1, KD2, KD3, KP, KE. I'll calculate weighted average for all. So let's read one question for a better understanding. You know, sometimes a confusion arises that one company has 3:1 debt equity ratio, other company has 1:1 debt equity ratio. So what debt equity ratio should I put in this formula? Look, if I want to calculate beta L for A company, then I should put debt equity ratio of A company. If I want to calculate beta L for B company, then I should put debt equity ratio of B company. If I put beta L of C company, then I'll put debt equity ratio of C company. So what about unlevered company? What about its debt equity ratio? Look, it is unlevered. It doesn't have a debt equity ratio. It's zero debt equity ratio. So an unlisted company has debt equity ratio of 2:3. This 2:3, sometimes it may confuse you. So when I say 2:3, it actually means 0.67:1. So an unlisted company has debt equity ratio of 2:3 or 0.67:1, while its comparable listed company has debt equity ratio of 2:1. Okay, its comparable listed company has debt equity ratio of 2:1 and equity beta of 0.15. Comparable listed company, 2:1 debt equity ratio, 1.5 beta. Tell me, this 1.5 beta, is it beta L or is it beta U? Okay, Vishwanath sir is saying beta L. Yes, that's right. This is beta L because it is the beta, equity beta of levered company. And that's why this is beta L. And tax rate is 30%. So now you just do one thing, that you put beta L into this formula, debt equity ratio into this formula, and calculate beta U as a balancing figure. Okay, before you solve this, 1 mark MCQ. So generally, beta L will be higher or beta U will be higher, or both will be equal, or none of the above. You can pass also. Generally, beta L will be higher or beta U will be higher, or both will be same, or none of the above, or you can pass. Exactly. Generally, beta L will be higher. All right, sir. Now you put beta L at this place, put 2:1 debt equity ratio, 1 minus 0.3, and calculate beta U as a balancing figure. You know beta L is 1.5. Now you calculate beta U. Okay, so one of the answers is 1.02. Not able to solve it? No worries, sir. I will solve it. Sure, I will. Okay, sure. Look, at the place of beta L, I'll put 1.5. Beta U will remain a balancing figure. Debt equity ratio is 2:1. So it is 2:1. Tax rate is 30%. So I'm trying to figure out beta U as a balancing figure. And one tip is don't do it in Excel. Do it on your calculator. That will be faster. Do the mental math or do it on your calculator. That will be faster. Yes, the answer will be 0.625. You know, it will be kind of 1.5 divided by 2.4. Yes. Interpretation is simple. If this company repays 100% of its debt, if it becomes unlevered, its beta will reduce to 0.625 from 1.5. So 2.4 is from here. 2 into 0.7 will give 1.4. 1.4 plus 1 will make it 2.4. But actually, we never wanted to calculate unlevered beta because our own company is levered with a debt equity ratio of 2:3. So now I will make it levered. So 0.625 I'll place here at beta u, and new debt equity ratio I'll write as 2:3. The beta u will be 0.625. This is 2:3, and I'll calculate new beta L. Okay, why we use the ratio of listed company? It is very simple. I told you, if you put beta of company A at the place of beta L. See here, if you put company A's beta, then here you put company A's debt equity ratio. If you want to calculate beta for company B, you put here debt equity ratio of company B. So I have put here 1.5 beta, and this 1.5 beta is for listed company. Therefore, I'll keep here debt equity ratio of listed company. Now, when I lever it again, so I'll do beta L is equal to beta U multiplied by 1 plus debt equity ratio. Now I want to calculate beta of unlisted company. Therefore, here I will put debt equity ratio of unlisted company. Got it, Anjuji? Repeat again. Okay, sure. 2:1 debt equity ratio. So I have bring it down to 0 level. Then I bring it up to 0.67, that is 2:3 level. So first I put here beta L to arrive at beta U. Now I put here beta U to arrive at beta L. For which company do you want to calculate beta L? For unlisted company. So put here debt equity ratio of unlisted company, and you will get beta L for unlisted company. Got it, everybody? This is how you calculate beta of unlisted company. Once you know beta, now you can calculate cost of equity also. RF is given as 10%, RM is given as 15%. Beta you have calculated 0.916. So now quickly calculate cost of equity, sir. Everybody. $14.58. Okay. I hope everybody is calculating. Right. The answer is 14.58%. Are we good to go? So now we will be solving one fantastic question. And before we do that question, I'm posting one question for you. What is formula for dividend payout ratio? What is the formula for dividend payout ratio? Wow, fantastic. That's the right answer. DPS divided by EPS. Perfect. So if dividend per share is 2 rupees out of earning of 5 rupees, 2 out of 5 is distributed, it means that the payout ratio is actually 40%. Now what is retention ratio? It is opposite to that of the payout ratio. So 100 minus payout ratio will give you retention ratio. 100 minus payout ratio will give you retention ratio. 100 minus 40% will give you 60%. There is a separate formula also, EPS minus DPS upon EPS. So out of 5, if 2 is retained, then 3 is distributed. So that 3 will actually give you answer of 60%. Okay. What is meaning of retention? Whatever is paid out is payout ratio. Whatever is retained for the purpose of reinvestment in the business itself is the retention ratio. So out of 5, if I'm distributing 2, that is payout. I'm retaining 3, that is retention. Right, sir? It is from company's point of view. Whatever company is retaining and whatever company is distributing. So out of 5, if company is distributing 2, The payout ratio for the company is 2 rupees. And retention ratio for the company, it is 3 rupees, that is 60%. Right, sir? Now we are going to solve one fantastic question. I request again to keep open the PDF file I have shared with you, because at some point of time the question will disappear from the screen. Oh, you need a tea break? So that we will do after this question. That means total distributable profit 100, out of that it pays dividend 60, balance will be 40 as retention. Yes, 100% correct. If 60 is distributed, 40 is retained. If 30 is distributed, 70 is retained. That's perfect. Immediately after this question, we'll have a tea break. So Tata Corporation, a manufacturer of do-it-yourself hardware and houseware, reported this. Now this is a fantastic question. Earning per share of rupees 2.10 in 1993, on which it paid dividend per share of 0.69. So paid means, what do you think? It paid means it has already paid, or it will pay after 1 year? What do you feel like? This dividend is already paid, or it will be paid after 1 year from today?
Paid after a year.
Okay.
Paid.
Okay. We have 4 answers in total, sir. Yes, exactly. Is already paid. So what do you feel now? Is it D0, that is current dividend, or is it D1, dividend after 1 year?
D0.
Right. This is D0. Perfect. So probably this is calendar year. At the end of 1993, we are standing, and here 93 is our 0 year, 0.69 rupees is D0. Earnings are expected to grow 15% a year from 1994 to 1998. 93 is 0 year. So 94, 95, 96, 97, 98. For next 5 years, earnings will grow at the rate of 15% per annum. Growth in earning is 15%, during which period dividend payout ratio is expected to remain unchanged. You know, payout ratio remain unchanged means, suppose currently payout ratio is say 33%. If current payout ratio is 33%, then in the years to come, this 33% payout will be maintained. If earning is rising and payout ratio is same, it means dividend is also rising. Look, earning is rising, payout ratio has to be maintained at same level. It means along with earning, dividend is also rising. So earning and dividend both are rising at the rate of 15% per annum. After 1998, that is 6th year onwards, the earning growth rate is expected to drop to a stable of 6%. So this is the 2-stage dividend discount model, sir. For first 5 years, we'll make a table. 6th year onwards, we will apply the formula. For first 5 years, we'll make a table, and 6th year onwards, we will apply the formula. The firm has a beta of 1.40 currently, and it's expected to have a beta of 1.10 after 1998. Current beta is 1.40 and expected beta is 1.10. Now, fantastic thing is you have 2 betas now. One is the beta for first 5 years. Then there is a beta for 6th year onwards. First 5 years beta is 1.4. So first 5 years cost of equity will be comparatively higher. 6th year onwards beta is comparatively less. So KE will be less. Now you'll have two discounting rates. The treasury bond rate is 6.25%, which is risk-free rate. And market risk premium is 5.5%. What do you think, sir? 5.5% is what? Is it RM or RM minus RF? Or is it RM minus RF into beta?
RM minus RF.
Okay.
RF minus RM.
Yes. Exactly. It is RM minus RF. So with the help of that, we can easily calculate cost of equity because you know beta and you know this. So what I can do here is, first of all, why don't you calculate cost of equity for first 5 years and for remaining years? Now question will disappear from here because I am shifting to Excel sheet. To keep watching the question, use your own PDF file, sir. Okay, one of the KE is 13.95%. What about the other KE? The formula is also there in the PDF file, sir. It is RF plus RM minus RF into beta. Yes, I have intentionally stopped the screen, sir. RF plus RM minus RF into beta. So everybody getting this answer? 13.95 for first 5 years and 6th year onwards. First 5 years means 94, 95, 96, 97, 98. And 6th year onward means 99 onwards. It will be 12.3%. Answer is in front of you, sir. Just check it and make it sure. Any doubt to anybody in these two calculations, cost of equity? No? Okay, great. So now, for how many years I will have to make table? First 5 years growth rate of 15%. Thereafter growth rate of 6%. So for how many years, minimum, for how many years I'll have to make table, sir? 5 years. Yes, that's right. I hope you're trying to calculate it, sir. Everybody.
Yes, sir.
Okay. So this one is wrong, no? 6% it should be. Are you getting this? 3.55.
So ये DPS में DC to 103 क्या calculation किया?
EPS में which year?
6th year 2.9.
हाँ, like. अब देखिए, everybody, I need everybody's attention. In fact, 6th year's EPS is simply 6th year's EPS is simply 5th year's EPS multiplied by 1.06. That is applying 6% growth. But DPS I will not calculate this way. because question is saying the dividend payout ratio will change. It is saying that the payout ratio is expected to increase to 65% of earnings. Payout ratio is expected to increase to 65% of earnings. So that's why in sixth year, I have taken EPS for sixth year and multiplied it by 0.65.
Which means that the earning for that particular year and the payout ratio, right, sir?
Right, exactly.
Okay.
Earning for sixth year multiplied by payout ratio 65% will give you 2.91.
So in a practical scenario, how we keep these kind of things in mind then?
Actually, dividend policy, if management is planning to change, then they will intimate you that we will change the dividend policy, not at the fifth year, that maybe you look at the history and you say, oh, you guys are distributing 30% dividend. In a talk to the chief executive officer, he will say, yes, historically we were distributing 30% dividend, but now we plan to pay 50 or 60% because we are already at saturation. We don't need new fund to be blocked in the company. Why to unnecessarily increase the invested capital? Better to distribute it. So in a discussion, if it comes out that company is planning to increase this payout ratio, then only you can do this.
Okay, got it. So generally, sir, as per your experience, you have been experienced in corporate. So generally, what will be the payout ratio? It's normally constant, and or industry it has been changed.
Now here I'll tell you, here I tell you one interesting thing, that there are two things to make valuation. One is minority interest, and other one is majority interest. So whether you are planning to buy 5-10% shares in the company, that is minority interest. In that case, you make dividend based valuation. But if you are going to acquire majority stake in a company, 30, 40, 60, 80, 100% stake in the company, then rather than using dividend, you use free cash flow, gross gross amount for entire company, not for one share. So most of the time we use free cash flows and not dividend. So entire company's cash flow we calculate. Dividend thing is actually rare we take in real life.
Sir, if I'm considering right, free cash flow means the cash liquidity easily available in the hands of the company.
We will discuss it, sir. Free cash flow is a separate section to be discussed.
Okay, no issue, sir. Thank you.
Most welcome, sir. Let's do one thing, because this question appears to be taking more time. We can have a break now. And then after 10-15 minutes, we can continue this question. Right? So it's approximately 4:15. So 4:30 p.m. we will resume. Earlier I thought it will be finished in 15 minutes, but it may take more time. So 4:30 p.m. we will resume, sir. Right, sir? Thank you. Okay. So here we go.
Yes, sir.
Question number 8 we are doing. First year's EPS is 2.10 plus growth rate of 15%. Then again 15% growth rate, we keep on adding. And in the 6th year, we add a growth rate of 6%. Now, as far as dividend per share is concerned, so first year's DPS is 0.69 into 1.15. And then we keep adding 15% growth to it for 5 years. But look, 6th year's dividend, how do I calculate it? I take 6th year's EPS and multiply 0.65 to it to arrive at 6th year's DPS. Now, meanwhile, I calculate NPV of dividend because EPS is not a cash flow for shareholder, but DPS is a cash flow for shareholder. And DPS is present value of DPS is 3.55. And you can observe it that I have used 13.95% discounting rate to calculate present value of dividends. You know why? Because for first 5 years, discounting rate is 13.95. And these are the cash flows for first 5 years. So if there is any doubt so far, just feel free to ask. And if you have already done it, then we can go ahead. Can we go ahead? Vishwanath sir, can we go ahead?
Yes, sir.
Okay, great. So let's move. Now, using 6th year's dividend, 2.91, what can I calculate? Can I calculate P5 or P6 or P4 or what? Okay, thank you, Shubham. 2.91 6th year's DPS I am using. So I'll be able to calculate what? P6, P5, P4. 2 answers so far. 3. Wrong answers are also invited, but no answer is discouraged. P5. Okay. Only 4 persons have some idea. Question repeat. My question is 2.91 is dividend for 6th year, sir. I will use this dividend in Gordon's model formula. So when I put it in Gordon's model formula, I'll be getting price for which year? P5, P4, P2, P1, P6. So now majority is saying it is P5 and majority is right. You know, when you put 6th year's amount, you get 5th year's price. Now the next thing is P5 is equal to A6 upon R minus G. A6 is C103 upon R is 12.3%. Notice it. 12.3% minus 6%. 12.3% minus 6%. Have you noticed it? Now I'm not using 13.95%. Now I'm using 12.3%. And you know why? Because sixth year onwards, A6 onwards, cost of equity is 12.3% only. Then I'll calculate PV of P5. Now this PV of P5 is going to be most important thing. What is this PV of P5? Here again I can use NPV function actually. So I'll use NPV and notice it. You know, is it clear so far? 46.19 is, are you getting 46.19 everybody? If you're getting this same figure, you can type yes, else you can say no. Exactly, Shubhamji. Fantastic. Great. Now the most interesting thing, PV of P5 equal to NPV bracket open, and now the rate I'm using is not 12.3. Now the rate I'm using is 13.95%. And then I'll put 5 commas. You know why 5 commas? Because this is the 5th year's figure. Five commas, and then I click this 46.19. And then I close bracket. You know why I'm using 13.95%? Because 6th onward, the rate is 12.3%. But between 1 to 5 years, the rate is 13.95%. So when I bring down 5th year to 0 year, I'm not moving between 6 to infinite. I'm moving between 5 to 0, 5 to 4, 4 to 3, 3 to 2, 2 to 1, 1 to 0. Right? And finally, I calculate P0. And this P0 should be equal to these two figures. Just observe it carefully, and then you also try to solve it, sir. Sure, I will. Okay. Think about it like this. Say I create a table here. 1, 2, 3, 4, 5, 6, 7, 8, and infinite. So here the rate is 13.95% for 5 years. And then the rate is 12.3%. So if a cash flow has to travel from 8th year to 0 year, suppose I'm explaining why we are using 13.95% as a discounting rate over here. So first 5 years rate is 13.95%. 6th year onward it is 12.3%. If a cash flow is at 8th year, so usually the formula for present value is PV is equal to FV divided by 1 plus R to the power N. You know, okay. If you forgot it, I'll show it to you again. This is the formula, sir. PV is equal to FV upon 1 plus R to the power N. So if a constant discounting rate is prevailing for entire period, say 13.95%, then I'll do 1 divided by 1.1395 rest to the power 8. This is how I will do it. Say 1000 rupees is receivable. I'm creating a new example. Suppose 1000 rupees is receivable at the end of 8th year. And suppose a single discounting rate is there during the entire period of 8 years. Then this is how I discount the cash flow. But if the question says that for first 5 years, discounting rate is 13.95%. But thereafter, the discounting rate will be 12.3%. Then, you know, I'll have to discount it like this. 8 years, I'll break down into 2 parts. First 5 years, I'll use 13.95. Remaining all years, I'll use 12.3%. So 8 to 7, it will come down at 12.3%. 7 to 6, 12.3. 6 to 5, 12.3. But 5 to 4, 13.95. 4 to 3, 3 to 2, 2 to 1, 1 to 0, 13.95. So a single cash flow will have to travel at 2 different rates up to 0 year. And that is what exactly we are actually doing.
Will it not make a difference in your example that where you are using 5 and 3 interchangeably? I mean, for first 5 years, the rate was different. The next 3 years, the rate was different. So in this, when you do it mathematically,
Sir, now you are raising a new question. So I'll answer to that also. Definitely I'll answer it, sir. But first, let me finish this one.
Okay, sir.
So this is how it is happening. That's why from 6 to infinite to 6 cash flows were there. We brought it down at 5th year at the rate of 12.3%. We brought it down at the rate of 12.3%. Okay. And thereafter, what happened when it reached 5th year, then the rest of the journey from 5 to 0, now it is traveling at the rate of 13.95%. Two discounting rates are there. You know, if you make FD in a bank and bank says that for first 5 years, we'll give you interest at 13.95, but for remaining 3 years, we'll give you interest at 12.3%. So fine. First you apply 13.95, then you apply 12.3. Now, last question asked to me was something different. Now you are saying that if 12.3% is there in first 3 years, and then 13.95% is there in remaining 5 years, then will I get the same answer? So that is just mathematics. Yes, you will get the same answer because 5 times you have to apply 13.95 and 3 times you have to apply 12.3. So that is the basic rule of mathematics. Whether you do A into B or you do B into A, the result is actually same. But our situation is not this one. Our situation is not this one. Our situation is this one, sir.
Your screen is not visible. I mean,
okay, Excel sheet I will share. So for first 3 years, it is 12.3, and for remaining 5 years, if it is 13.95, the result will be same. That is A into B or B into A. 4 into 5 is equal to 5 into 4. But this highlighted area which you are seeing, this is not our question. Our question is this one, sir. First 5 years, the rate is 13.95 and thereafter it is 12.3%.
But I somehow feel that mathematically also it may not be same because
it will be same. It will be same. We can prove it, sir. It will not take much time. But I must tell you, rest of the audience, that now we are not discussing this question number 8. We are discussing a different concept. Otherwise, other people may get confused.
Yes.
So I will tell you, sir. I'll give you a quick. Sorry?
I can take it offline if it's okay.
No issue. I'll just tell it to you right now. It's not a big deal. So 1395 raised to the power 5. Okay. And just to be safe, I'll put this also in the bracket. So this is for 5 years I am charging. Future value I am calculating, suppose. For first 5 years I am charging 13.95% on my fixed deposit at the bank. And then just a minute. I can remove one extra bracket. So this is 1000 multiplied by 1.1395 raised to the power 5 multiplied by 1.123 raised to the power 3. So this is the final answer. I can break it down into 2 parts also. That for first 5 years I am charging 13.95%. So my 1000 rupees of FD will become 1921. And then on 1921, I can apply 1.123 raised to the power 3. So finally my FD maturity value will be 2720. If I do the reverse thing, that for first 3 years, bank is giving me 12.3% interest. So at the end of 3rd year, my FD will be 1416 rupees. And then for remaining 5 years, bank is giving me 13.95% interest. So the maturity value will be same. Intermediate step will be different, but the final value will remain same, sir. That doesn't make a difference. Right, sir?
Yes, sir.
Okay, great. So I was just telling you, this is our situation. Our cash flow from infinite year to 5th year, it traveled at the rate of 12.3%. And then from 13.95 to 0 year, it will travel at the rate of 13.95. So say you are staying at Mumbai and somebody tell you that near Indore there is a city called Ujjain, one of the 12 Jyotirling, Mahakaleshwar is there. और आप वहां पे जाओ और वो what do they call it, काल सर्प योग की पूजा करवाओ तो आपके सब संकट दूर होंगे, kind of. And you ask me how to approach Ujjain, I'll say you take a flight from not COVID-19, normal situation. You take a flight from Mumbai to Indore, and here I'll book a taxi for you. So from Indore to Ujjain, you go by taxi, and you say fine, that's fantastic. Now from Mumbai to Ujjain, your journey is split into two parts. One is by flight and one is by road. So similarly, here your journey is split into two parts. This is by flight from Infinite to 6. In one shot, quickly you reached at 5. But Indore to Ujjain, 1 hour it will take now. 13.95% rate will be applied from year 5 to year 1. Year 0. Rao. Yes, Rao is also nearby Indore. How do you know that, Shubham? Have you ever been? Oh, yes. Indore is one of the luckiest city which has both IIT and IIM. So IIM is situated at Rao. Yes. You did some training over there or what?
No, sir, actually there is an integrated program after 12th. So I tried there, but unluckily fall short in interview.
Yeah, actually it's a very tough. 4 lakh some people appear for 120 seats.
Right.
It's a very tough fight. Okay, great. All right, sir. Any doubt to anybody in this question now? I just want to make sure your participation, sir. If you're not getting, feel free to ask. And if you have done this, then let's go ahead. So we have solved the whole question. Question was asking what is cost of equity in 1999. So that was 12.3%. Then what is the stock price at the end of 1998? So 98 stock price was 46.19. Then it was asking what is the stock price in 93? That is 27.59. And then that's it. Now we have question number 9. And it's a fantastic question. This is also a good question. And in fact, I must say this, question number 8, question number 9, these are exam type case studies. Up to question number 7, what we did were concept questions. But now question 8 onwards are exam type case studies are there. In fact, this question number 9 was asked in my examination also. Those days, Bombay Stock Exchange used to take examination, not NISM. And I appeared from Ahmedabad center because Indore was not the center. So I went there and then they said, no, we don't allow MS Excel. I said, fine. So it took more time to calculate because, there are calculator short tricks and you can run faster, but still Excel is always more comfortable. But nowadays it is very clear that all NISM centers, they do allow you MS Excel. But on the safer side, before you go to examination hall, you can check with them that whether they do have the licensed copy of MS Office or not. If they don't have licensed copy of MS Office, then they will allow you to use one free open source software, which is Apache Open Office. Apache Open Office also offers a spreadsheet, which is similar to Excel. Apache Open Office is similar to Excel. So either they will have Excel or they will 90% of the centers have Excel. Some of the centers don't have. In that case, you can use Apache OpenOffice. You can visit the center one day before and make it sure that whether they do have it or they don't have it. There is one difference, like in PV function, we were putting commas, PV and PV, we were putting commas. In Apache OpenOffice, the same function will be there, but there they put semicolon. In Excel, you put commas to separate. That is rate, comma, NPER, comma, PMT, comma, PV. The same thing will work in Apache OpenOffice also. But in place of comma, you need to put there semicolon. Rest all things are same. As far as this exam is concerned. Calculator, yes, calculator is allowed, but just the ordinary calculator you can carry. You cannot calculate, you cannot carry scientific calculator or any spatial financial calculator. That is not allowed. So this question number 9 was asked a similar question. That question was lengthy enough, but the crux of that question was similar to this question. So, if somebody faced this question for the first time, it's difficult. I'll not say very difficult, but 10 out of, I think 7 out of 10 people will do it wrong at least 1 or 2 steps. And 3 people will be able to solve it if they face it for the first time. This is a good question. When these exams will be held? Shailen sir, it's very simple. Once you complete this 50 hours of training, RVO will give you certificate of participation. Once you get certificate of participation, go to the NISM website and book your examination slot if it is open in your city. Looking at the COVID situation, you need to upload this certificate, and on the very next day you can appear in the exam. It happens 5 days a week. NISM is the entity which conducts examination. It is a kind of subsidiary of National Stock Exchange. But the exam is controlled by IBBI, Insolvency and Bankruptcy Board of India only. NISM is just, the examination center. Nothing more than that. So it is January 2009. It means end of year 2008 is your 0 year. That's good. A company has given dividend for year 2008 equal to rupees 0.175 per share. Yes, sir. Once you clear the exam, then you need to register yourself with IBBI by paying fees and filling up a very lengthy form. And then you will have the certifying power. So guys, a company has given dividend of year 2008 equal to rupees 0.175 per share. Okay. Tell me, is this D1 or D0? Come on, quick, and everybody need to participate. Even if you type pass, but you need to be quick and you must participate. Four, 5 answers. 6, 8. Okay, yes, this is D0. Fantastic. Growth in dividend expected for the next 8 years is 14%. And thereafter it will be 7% forever. So growth in dividend for next 8 years is 14%. And thereafter the growth will become 7% forever. Okay. So tell me, for how many years I'll have to make a table? Praveen sir is saying 8. Shubham ji is also saying same. Yes, exactly. At least 8 years. If I choose to make a table for 10 years and then calculate terminal value, the intermediate step answer will be different, but the final answer will remain same. At least 8 years table is required. But if I choose to make 10, 12, 15 years table, answer will be same. If I choose to make table for infinite years, then also answer will be same. Next, this part of the question we will attempt it later. So this is the question and you need to solve it quickly, sir. We have done many such questions. So this time you have just 5 minutes time and you have to calculate fair value. Risk-free return is 4.1%. Risk premium on market portfolio is 5.5%. Beta of the security is 0.84. So calculate cost of equity. Then calculate NPV for the 8 years cash flow. Then calculate terminal value. Calculate PV of terminal value. Make sum total to arrive at P0. You can start to solve it now, sir. KE is 8.72%. So what other people are getting as KE, sir? Okay, that appears to be right. Perfect. So what is NPV for first 8 years? $1.74. Okay, let me check that. $0.175, 14% and 7%. Yes, Atul sir. 1.74 is the correct answer. You can cut and paste your solution to start it from A112 so that it become easy for you to reconcile. Like just select this one, Control X and paste it at A112. Calculate terminal value, sir. P0 is 17.65. Wow, fantastic. Very nice, sir. But terminal value, I request everybody to calculate it. Okay, at least tell me cash flow for 9th year, sir. .53. Okay. Perfect. It's 0.53. And tell me one thing, I'm asking everybody, what should I calculate now? P8, P7 or P9? Okay, two answers as P9, two answers as P8. Amardeep sir, P0 is the final destination. I'm asking about this intermediate step. P8, P8. More people for P8 now. That's the right answer, sir. Try to recall. First year's cash flow, you put 0 years value, you get. So 9th year's cash flow, when you put, you'll get 8th year's value. You can think about it like this also, that for first 8 years, I'll be getting dividend. And at the end of 8th year, I'll sell out the share. Think it like this, that this share is redeemable at the end of 8th year. So for first 8 years, receive dividend. And at the end of 8th year, it's the terminal value. So tell me, okay, P9 formula you need. It's here, Amardeep ji. Now calculate P8. That is the terminal value. So what is the amount of P8? Then calculate PV of P8 and then calculate current fair value. $31.06. Yes, that is probably right. Okay, no worries, sir. P8 we will calculate together. So try to recall the formula. I just recommend that if possible, take a print of the PDF file I have shared with you. That will make it easier. Like formulas are written over there. So P8 will be 9th year's cash flow upon R minus G. So this is 9th year's cash flow divided by rate is 8.72%. Oh yeah, percent minus growth rate is 7%. 31.05. Now I'll calculate PV of P8. So I can use NPV formula. Rate is 8.72%. I can put 8 commas because it is 8th year's value. Then finally I can calculate P0. Which is 17.65. So I have posted one link over here. It's my humble request to everybody to please copy this link and paste it in a new tab in your Excel sheet. Open a new tab in Excel sheet and paste this link in a new Excel sheet tab. Because my past experience says that this link is demanded many times. If there are 100 candidates, this link is demanded 50 times. So here it is expected that it will be demanded 6 times more in the next 2-3 days. Because people lost track of it. My humble request to everybody is copy this link from the chat window and paste it in the same Excel sheet where you are working currently. You can open a new tab, new sheet, not able to copy. Control, okay. But I don't know. You are not able to copy it. Let me check what is the problem. Sir, then just do one thing. Click this link. When you click it, it will open in a browser. And once it is open in a browser, then from the browser, you can copy and paste it. Click the link. Open it in browser. Then from browser window, copy it. And paste it in the current Excel sheet, which you have already saved, in a new tab, in a new sheet. So that tomorrow you won't have to search the whole sheet. So whatever I teach, like this Excel file on which I am currently working, after the session ends today, I'll post this Excel file in this Google Drive link. Tomorrow also I'll do the same. Next day also I'll do the same. I hope you are able to do it this way. Open in the browser and then paste it. Otherwise, then you will demand it on WhatsApp, and on WhatsApp again it will be demanded an enchanted day. So just save it, please. Okay, that's good. Now let's go ahead with this question. Any doubts so far? 17.65, everybody, is everybody getting 17.65? Any doubt to anybody? No doubts? Okay, great. Fantastic. So now let's read the question, remaining part of the question. Oh, before I read the remaining part of the question, let's do one more thing. Listen carefully what I am saying. Total value is 17.65. So 1.74 is the value coming from year 1 to year 8. And 15.91 is the value coming from terminal value. Hence the total value is 17.65. Right, sir? So if somebody asks you that how much percentage of the value is contributed by terminal value. So I'll do 15.91 divided by 17.65. That is 90%. Okay. Have you got this answer? 90.12%. How much of the value is contributed by terminal value? So I did one simple thing, 15.91 divided by 17.65. So you must be getting 0.90. 0.90 means 90% of the valuation is contributed by terminal value. What does it mean? Terminal value is really very, very important. And terminal value is in turn affected by the terminal growth rate. If I change terminal growth rate, say from 7% to 8%, just 1% increase in growth rate, see, the value of 17 rupees has gone up to 39 rupees. That is more than double. So you need to be very careful while choosing a terminal growth rate and calculating terminal value, because it is the major contributor in the total value. Right, sir? And now let's get back to the question, because a part of question is yet to be solved. Retention ratio is 70%, while the price earning ratio at the end of 8th year is expected to be 17 times. Now they are giving us retention ratio and price to earning ratio at the end of 8th year, which is 17 times. And question is asking us, just a minute. Okay. Question is asking us to calculate terminal value of the share as per market multiple method. I told you what is market multiple method. Like one of the example is price earning ratio. You can calculate market multiple, and then accordingly you can find out the final value. So terminal value, in the last solution, we calculated terminal value using Gordon's model. But now question is asking us to calculate terminal value using market multiple approach. Now you look here. Question is saying that retention ratio is 70%. If retention ratio is 70%, it means payout ratio is 30%. If I'm retaining 70%, it means I'm distributing 30%. Now, you know the formula for payout ratio is DPS upon EPS. And look here, retention, dividend payout ratio is 30%. Now, what is DPS at the end of 8th year? So look here, DPS at the end of 8th year is 0.499. DPS at the end of 8th year is 0.4992. So if I want to calculate EPS at the end of 8th year, I'll put DPS 0.4992 and retention ratio is 70%. Therefore, payout ratio is 30%. So as a balancing figure, I can calculate EPS to be 1.664. Sir, it is very simple. You know the dividend is 49 paisa at the end of 8th year. And you know that it is 30% payout. So if this is 30%, what is 100%? So 0.4992 should be divided by 30%. So that the EPS for 8th year is 1.664. Any doubt to anybody for this 1.664 EPS? Okay. Now we know that price earning ratio is market price per share upon earning per share. And if I rewrite this, it will be EPS multiplied by price earning ratio is MPS. EPS multiplied by price earning ratio is market price per share. So 8th year's EPS is 1.664. This is the EPS for 8th year. And 8th year's price earning ratio is given as 17 times. Look here, question is saying it is 17 times. So if I calculate terminal value, not as per income approach, but as per market approach, my terminal value at the end of 8th year will be 28.29. You know, if I calculated terminal value using Gordon's model, the terminal value was 31.05. This is income approach, Gordon's model, growth approach. But if I calculate terminal value using market multiple method, it is 28.29. So one of the MCQs, terminal value of the share as per market multiple method, it is 28.29. So answer is actually B. Then current value of the share applying dividend growth model that we have already calculated. Current value of the share applying dividend growth model is 17.66. Third question we will attempt later. Fourth question we have already solved. What percentage of the value what percentage of the value comes from terminal value? So 90% of the value comes from terminal value. 90% we have already calculated. 17.66 we have already calculated. Terminal value as per market multiple method 28.29. We have recently done this. Now the last MCQ, second one. Current value. Now you have to calculate current value, current fair value of the share. Oh, sorry. We have not this one, rather than this one. Current value of the share when you apply market multiple method for terminal value. Now you have to use income approach, but terminal value should be as per market multiple method. So 28.29. Look here, what I'm going to do now. I'll copy and paste this part of the question. Look at it carefully. I'm copying P8, PV of P8 and P0. I'm copying P8, PV of P8 and P0. I copy it and paste it somewhere. Now, at the place of P8, I'll place 28.29. Now, this is not 31.05. Now it is 28.29. Now you will ask, how come 28.29? It is EPS multiplied by 17 times. Then PV of P8, the same way, 8 commas, 8.72%. Now what is P0? I will have to recalculate this one. 1.74 plus 14.49. See, this is same as before. There is no change. Or I can simply do one thing. If you don't want to do this part of the question, you can simply do one thing. This 31.05, if you put here 28.29, see, you'll get the same, not 28.9, 28.29 if you put here, you'll get 16.24, okay? But I don't want to disturb this part of the solution, so I copied and pasted it. 28.29, market multiple terminal value, PV of terminal value, 14.49, current fair value, 14.49 plus 1.74 for 1 to 8 years. So the answer is 16.24. The question is asking third MCQ. Answer for third MCQ is 16.24. It was asking current value of the share when you apply market multiple method for terminal value. This approach has become a hybrid approach. So for first 8 years, you are using income approach and you are discounting cash flows. But for terminal value, you are not using income approach and you are using market multiple approach. Try to recall, there are 3 approaches: income approach, market approach, cost approach. In this question, we are using a mix of income approach and market approach. So that's kind of hybrid approach. Right, sir? 16.24 is the answer. Now ask me if you have any doubt on this.
Can you go back to Word file?
Yeah, sure.
Can you go up? There was one calculation that yes, this one. You will be sharing this Word file also?
I will be sharing, but I'll put it in the Excel file itself. Because
Yes. That will be a favor. Thank you. Okay, thank you.
Most welcome. Yes, sir. Any question on this? I know this has been a long day for you, but still I'll request that try to go through these questions, same questions which we have done, at least last 3 questions, try to go through the material so that tomorrow when you come, whatever we studied today should be crystal clear to you. And if there are any doubts, jot it down. And tomorrow at the beginning of the session, you can ask those doubts. Tomorrow we'll be learning something new, like how to calculate free cash flow to equity and free cash flow to firm. And then making a valuation. Right, sir? So kind of, we are already over time by 11 minutes. Wish you a good day. अब वैसे आपका पूरा दिन तो मैंने ही खत्म कर दिया है, दिन में कुछ खास बचा नहीं है. But anyways, कल सुबह सर फिर मिलते हैं. Again, 9:30 AM. Thank you, Amardeep sir.
Thank you very much.
Thank you, Praveen sir. So we'll try to start at 9:30 sharp, sir. All right then. Thank you. Bye bye.
Okay. Thank you.
Bye.